so do markets. It's Wednesday, June 18th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Glenn Freiberger in Chicago. Welcome. Thanks for stepping in for Dylan today. He's getting ready to take Tom and Tony around Europe, which should be a lot of fun. We're here for the next hour as we take you through the futures market close, 5 p.m. Eastern, 4 Central. If you're joining us on the platform, tastylive.com. Welcome. Thanks for joining us. Come over to YouTube. Tell us what you're trading today, what you think of this market action. Before we get there, of course, I think it's worthy to remind everyone the futures market is still open right now. And if you have any last-minute trades you like to get across the board, now is the time to do them, or you hold your peace through tomorrow because, of course, the market's closed tomorrow for Juneteenth federal holiday. When we see the futures close today at 5 p.m., it's basically like a Friday close, and then tomorrow is effectively a Sunday open, where we'll be back again trading at 6 p.m. It's why we warned that if you had dividend-affected positions today or for Friday, you should roll them today. Okay, so that's all off the board, guys. The Fed kept rates on hold. That was not a surprise. 99+% chance of them doing so, according to Fed Funds futures spreads. Going into today's meeting, the policy statement itself did not change either. Outside of the date and maybe changing a name here or there, the red line was
boring.
The same we saw in May. Very boring. But what we did see was a change in that summary of economic projections. We see that the Fed is cutting their growth forecast. They're boosting their inflation forecast. They're telling us that we're still going to get 2 cuts for this year, but ultimately maybe not so much more in the future. They are forecasting a higher structural Fed funds rate, a higher for longer, if you will. Stocks don't love it, nor do they hate it. Neither do bonds. It's a flat day right now. S&P is now flat for the session, 0%. NASDAQ's off by 0.01. Russell is the only significant outperformer, up by 0.56% here. Ilya, because you and I just had a chance to talk on last call for a bit, I just want to kick it over to Glenn here for some thoughts. Please. Glenn, you know, this is a big day for us, particularly for FX people like yourself.
Oh, yeah.
We care about the central banks, and I don't know if this one left much of an impression. How are you seeing things from your side of the desk?
Yeah, I mean,
what's happened today?
I mean, if you set the backdrop for me this morning, war, FOMC, random holiday coming into the middle of the week, I would have expected things to be a lot more exciting. And even so, one of my predictions for this day, how it would unfold, is with getting the summary of economic projections, getting a lot more numbers on the release of the meeting, I would have thought the move, and knowing how cautious Powell tends to be and everyone kind of expecting what he's going to say at this point, would have thought the move would have been at the 2 p.m. Eastern time, at the release of all of those economic projections, all those new numbers. And we saw kind of a muted reaction there, and the slide coming actually during Powell's commentary, which I thought for this occasion would have been reversed. So that surprised me a little bit. But inside moves all around, tracking dollar prices, we did see a little bit of dollar strength come back. The snap reaction was dollar weakness, as you know, the 2 cuts. Taking the headline there, a lot of people thought that they would edit the dot plot to perhaps just 1 cut this year. And so an initial dovish reaction, but once Powell got on the mic and started saying, the rhetoric around the inflation costs will be passed to someone, we don't know who, we all know who. But then we saw the dollar start to get bid up. A lot of that tension release in pairs like the euro dollar and pound dollar that were pretty wound up beforehand, and even some more back and forth in the Australian dollar and Japanese yen, who were moving, trending in the dollar's favor, or not in the dollar's favor leading up to the meeting, and now coming back a little bit. So a little bit of diverse price action from a charts perspective, but pretty unanimous across the board. Dollar story starting to get a little dollar bid.
Ilya, it seems like the dollar is coming back here a little bit. I'm just flipping through some of the spot FX positions on the chart, and you can see that once you get that initial shakeout where the dollar softens up a touch with the release of the policy statement, and realistically, it's the summary of economic projections that get it
Right.
moving,
Yeah.
given the lack of changes. The dollar does make its comeback as Powell begins to speak. And, you get the sense right now that at the margins, the news flow, the tariffs, the geopolitics of it all, it puts the Fed in a position where it does need to continue to wait to see if the timing is right. Ilya, I can't help but reconcile the fact that 2Q GDP, even if it's just for accounting purposes, is going to be much stronger than what we saw than in Q1. And so the Fed is probably not going to have the ammunition in its back pocket of a recession by July, right? Because the July meeting, right, to say whether or not they should start cutting. It seems like the Fed is going to be sticking around in its current location for a while longer than probably people want it to, than it would like to, but its hands are tied right now.
Yeah, and I don't think currency markets are particularly surprised by that, or we'd see the dollar strengthen more considerably. I think when you look at really what's happened, if we can just zoom back here, this is a 5-minute chart that we're looking at. If we go to a daily for the yen, if we go to anything a little bit longer term, we can see that the dollar has been facing relentless selling since the beginning of the year. We saw that, of course, in April. We had the whole scare at the beginning of the month with Liberation Day. And against that backdrop, once that sort of normalized a little, we saw the dollar strengthen a tad and then come right back in and establish a kind of sideways consolidation. If we look at the yen, similar story in the euro, similar story in the pound, really stubborn consolidation with almost no motion at all in the Aussie. But whereas stocks have clearly recovered off those April lows, the dollar has not really managed it. And so one of the more interesting things here has been this sort of relentless bearishness on the dollar in markets. It doesn't really seem like that bearishness has a very concrete argument to unravel on the basis of what the Fed said today, because as we were just saying on last call, the only kind of notable change in the SCP, everything else was very predictable, right? The Fed signaled already as recently as May, we're going to increase the unemployment rate forecast. We're going to lower the growth forecast. We're going to increase the inflation forecast. That's exactly what happened here. We're going to widen the bands around those forecasts because uncertainty has increased. We really have no idea what's going on. All we're saying is we know tariffs historically are going to have these effects.
Did you find that to be, I saw that uncertainty, and we measure uncertainty as the bands around the forecast widening out. The Fed says here, uncertainty about the economic outlook has diminished.
Yeah, what the heck?
But remains.
I mean, I think you look at the S&P 500 and you hear what Powell says, and he goes, well, since April, it's diminished. Well, yeah. yeah. Since April, it's diminished.
Thank goodness.
Can I say that I just sat and listened to the whole meeting? And then halfway through, I started playing it back from the beginning while I was listening in one channel, and then I had it on mute on the other because I think watching Powell's body language is an interesting enough exercise. Yeah. I walked away thinking that the Fed has no clue what's going on right now.
They're saying as much. They are loudly saying, "Hey, look, with an unemployment rate at 4.2 and an inflation rate at 2.4, why in the world would we try to make up our mind now?" Well, it's going to take time for the tariffs to work their way through the economy. But the upshot, again, dollar-wise, yields-wise, I think is the market is very much not on the Fed's page when it comes to this change in the rates forecast, where they went and dropped the rate cut from 2026. The market is flipped the other way. They think we get the 2 this year, and then we get more easing next year, not less. As that speculation builds, it'll be tough for the dollar to go up in a lasting way. It'll be tough for bonds to stay anchored.
I just realized this is not the correct. That's the correct one. Not sure why I pulled up last year's. Okay, so one thing that I noted here in the language too, the unemployment rate remains low. They changed from has stabilized at a low level in recent months. So low to the Fed is basically below 5%. But what we should be aware of is in the most recent non-farm payrolls report, the unemployment rate was technically 4.244%, which means if it was 4.245%, it would have been rounded up to 4.25%, which means it would have been rounded up to 4.3%. So just by the skin of our teeth did we miss seeing an unemployment rate miss last time. So if there is something the Fed's getting ahead of right now, there is this slight adjustment in my read through that the uncertainty persists because the situation's degrading. It's not falling off a cliff right now, but we're kind of gliding into a less comfortable economic environment moving forward because growth is revised lower again, unemployment's higher, inflation's higher. That's not stagflation itself, but it smells stagflationary. You don't technically have high unemployment, you don't have negative growth, you don't have high inflation, but lower growth, higher unemployment, higher inflation, that's not a fantastic mix right now for sentiment. But sentiment's really bad in this market already, Ilya. I want to stick with the dollar here for a second because the dollar sentiment just kind of drives me up the wall for the most part. The action today, the dollar was lower. It does resolve itself to the upside. You can see that we're now testing the downtrend from the February, March, May, and perhaps now June swing highs here. The Bank of America Global Fund Manager Survey, which was released yesterday, shows that fund managers have not been this bearish on the US dollar since January 2005. We know from the futures market, the euro positioning is the most net long it's been over the past year. We know that the yen positioning is basically the most net long that it's ever been. We can just go down the list. The pound's in a similar situation. The Canadian dollar's in a similar situation. The dollar is really stretched. Glenn, how are you feeling about the greenback here? Because it feels like it's the most hated asset in the world right now.
I know, what the heck?
But that's probably a good opportunity for contrarians like ourselves to look long.
I agree. And the one thing you're pulling up here, DXY, to me, what screams out in the spot Forex market is if you're stuck looking at a chart like this, where you're saying it might break out of its bearish trend, you have a lot of unique chart patterns in these markets and a lot of opportunity to catch the dollar, regardless of if you are continually bearish or are betting on a dollar comeback. You have a lot of different charts to try and get in here on, and a lot of unique price points. So that's, in terms of unpacking the dollar story right now for me, I think that's the most interesting angle. I mean, you have the euro dollar at coming off of 4-year highs. You have dollar Swiss franc seemingly pinned at 10-year lows, but now starting to build some positive price action there. Just now in the hour after the Fed meeting, now returning to levels in that market that we saw last Thursday. That had been a significant laggard, a lot of pressure getting relieved in that market. And so I think maybe it's just me who's looking at these markets a little more than the average trader, but there's a lot more granularity and potential opportunity when looking at the spot dollar markets than the dollar index, because that's a pretty disheartening story overall, just putting the dollar in a basket and checking the year-to-date performance. So that's what I'm looking at. I've got some client sentiment from tastyfx, IG group clients, and that shows us that this dollar Swiss franc market, let's get in here in my, just hitting a refresh for you so I can get the most recent numbers. This dollar Swiss franc market, we've got client sentiment of 82% long. So that aggregates IG group exposure across the whole globe, and traders positioned. And what you're seeing is traders in the dollar yen market now split 50-50 at this 145 level. You're seeing euro dollar and pound dollar both net short to the tune of 60% net short, and then Australian dollar and US dollar, Canadian dollar both net long. So you're seeing a little bit of mixed positioning when you get that granular, as opposed to just one of the what did you say, the Bank of America
Right.
fund managers. So it's
actually
just
very, very interesting, very interesting numbers, because to your point, Chris, and yours, Glenn, the 80-20 split net long in a dollar Swiss would tell you you're getting to the kind of a place. And by the way, we should kind of preface this by saying retail sentiment tends to be a contrarian indicator. So what you tend to see is when a market builds net long, that market tends to be going down. That tends to be a bearish signal.
Can we explain? Do you mind if I explain why that's the case? Because
I think it's very important to explain why that's the case. Because it's not that people are wrong. That isn't what that's telling you.
Yes, right. So when we look to sentiment figures for retail traders, right, just as we would look for positioning for the COT report. So let's go backfill here a layer further. The COT report, the CFTC's Commitment of Traders report, is released once a week on Fridays at 3:30 p.m. Eastern. It covers the trading week from a Wednesday to a Tuesday. So the next COT report that we see will be the week through yesterday's close, for example. But that leads to a little bit of a problem, because you get the COT report on Friday and the data window closes on Tuesday. So market action Wednesday, Thursday, Friday morning, it's not accounted for in these positioning updates. Okay, then you have to wait another week. So what happens around the Fed today, for example, what happened with the positioning in the market with the Israel war starting with Iran, we're not going to actually see that until this Friday, even though the war's been going on for basically 6, now almost 7 days. So years ago was contrived. We got to find a more timely positioning indicator. We got to come up with a way to mimic the CFTC COT report, and we got to do it on a real-time basis, right? So we can look to our own client positioning to do so. And in doing these data studies, something interesting occurred. We've talked about this on air before, Ilya, but for the most part, if we were to just do a binary, were you right or were you wrong, retail traders themselves are actually correct more than they are incorrect. The problem comes because of scaling with risk management, where if you're right 55% of the time, but your average loss is twice the size of your winner, you're going to actually lose money, because you need to have a break-even rate of 2 to 1 if you're going to be wrong. Excuse me, if you're going to let your losers run twice as long as your winners. So you need to be right 67% of the time if you're going to let your losers be twice the size of your winners. And that obviously is not what happens here. So why do we look to the sentiment figures? Because when you see these extremes in sentiment, you could trade off of them. Granted, retail traders are usually right. Okay? They're usually directionally correct. It's because of the risk management and the inability to cut losers and let winners run that you see that they're offsides. And what makes this all the more interesting is when you look at the sentiment data and put it next to something like the COT report itself, you could see that retail traders behave specifically like speculators in the futures market, right? Which is to say that they follow trends, and at the tops, they try to fade them, and at the bottoms, they try to pick the bottom. So there's something to work with here. It's a tool that we use to help fill in the gap, because the COT report and other positioning data available in the market isn't updated on a day-to-day or even a minute-to-minute basis. My spiel's over.
Right, but so what, and a very important spiel it is, because first of all, it illustrates why all of us, when we start in trading, have to overcome, most importantly, the risk management side of things, because that really is what makes you successful or not. There's a gazillion ways to analyze markets across different time frames, but if you can't manage risk, then you can't make money over time. But it also illustrates how to read these numbers in the context of sort of their directional implication. You see in reading like 80-20 net long in dollar Swiss, and you go, okay, well, that's getting kind of high. That's getting to the point where you're getting near a positioning extreme. And although on the way into 80%, from 60, from 50, as you're growing net long, the implication would be that the bias is in the opposite direction, that a trend would continue to build in the opposite direction. So if retail is increasingly becoming net long, then the price is increasingly going down. At 80, you're getting to a place where sentiment might be at enough of an extreme where it actually flips. And at that point of exhaustion, people would start getting less net long. But of course, then the price would also be signaling that it's likely to go higher. You interestingly don't have that split, to Glenn's point about the diversity of what the dollar is doing. You don't have similar splits in the yen where you're at 50-50. It's not nearly as extreme in the euro where you're at 50-60, something like that. So the dollar here isn't obviously screaming that it's at a point of exhaustion on the down move. And when you look at the levels, I mean, just look at the pound here ahead of the Bank of England policy announcement here coming up in just a matter of hours. We're sitting squarely at former resistance turn support, and we will not clear it. It's a similar story in the euro. It's a similar story in the yen. The Aussie has basically been stuck in the mud for ages now, so it's difficult to even put levels on it. But all of this basically lines up to we've gotten to the bottom of the range, we've gotten to the deciding line, and we're going to either crack or bounce here. We've been in a sideways range for quite a while now, and that can relieve positioning all by itself. So when you look at something like the Bank of America numbers, and if you then end up saying, you know what, people have sold off some of their short exposure, but the price has only moved sideways and not up on that basis, that's very much a possibility to relieve some of these oversold levels without the dollar necessarily rallying.
I would look to today's candlestick in the pound as perhaps a sign that this thing is rolling over and the dollar's getting ready to rebound before we move off of FX and go back to the broader market. But you can see that the high today bumps into the 5 and the 21 EMAs, the 1 week and the 1 month respectively. Mm-hmm. We kind of break the downside of the trading range here. I go to that 4 hour, right? We clear out the
Very
lowest
possible.
close.
Very possible.
So that's the lowest close on the 4 hour on the 10th. We try to rally back into there, rejection, and then ultimately set a new low. The point is that the dollar has been beaten down. Everyone hates it. The founder of this network fashions himself a contrarian, and for the life of me, I am not that person. I'm a momentum guy. I'm the kind of guy who likes to look at a trend and go fishing and not think. Okay, it's very the kiss method. Keep it simple, stupid. But
you're starting to see that here.
The momentum looks like it's turned. And I think that's the prevailing point, if only as a point of interest. Look at MACD. MACD has not set itself down below its signal line with a sell signal going back to the start of April. And that was a temporary blip. Otherwise, for the majority of this uptrend that the pound's been in, that the Aussie's been in, that the euro's been in, you've seen these indicators stay in bullish territory. And they're starting to give indications that maybe those characteristics that have defined the past several months of trading, they're evolving. We do need to go, Glenn, I do want you to have the last word here on FX before we change the channel and go back over into equity markets.
Yeah, I mean, you nailed it there with the nice part about this dollar story is you had such an extreme run-up that if you're looking and possibly think that things are turning over and a dollar comeback is underway, you have time to and a lot of room to run to wait for confirmation if you see it, because it's not like a typical year where within a year you only have 5% to work with. I mean, especially against European currencies, these are up 10% already. So I think as much as these markets are wait and see, just like the Fed, if you are a dollar bull, you've got a lot of room to run. So I'd say no need to necessarily try to step in front of it. but it's nice to see a little more two-sided action.
Ryan, why don't we pull up, or Paul, why don't we pull up the slide here? Before we get off of FX, I think it's a timely reminder for everyone that tastyfx is now on the platform. You saw us tinkering down there when we moved through the tabs, but you can trade SpotFX now in the same place as everything else. If you go to tastyfx, or you head over to the watch list on the platform and you go over to Forex, you have the ability to sign up from there directly. Head over to tastylive.com, tastytrade.com, Glenn, tastyfx to find out more, right?
And there you go. You nailed it.
We nailed it. All right, let's go back to the charts here. Let's talk about what's happening broadly in the markets. We haven't looked at the sector performance here today as we got into the close. It is a mixed day by and large. 5, 10, 13 are in the red, 12 are in the green. So you have an S&P 500 that's up by 0.02. It's basically a clean split between winners and losers. Top performer today, Telecom, XTL. That's up 1.44%. You have the banks that are performing well as well. Too many wells. KBE, KRE are the best of the bank bunch. Otherwise, some rate-sensitive items like home builders were higher. Although, Ilya, today's economic data that came out, the home data was pretty god-awful, which, as someone who has a very particular pet peeve about housing and wants to see more of it built, basically wherever it can be built, building permits are down by 2% from 1.43 million to 1.39 million. Housing starts are off from 1.39 million to 1.25 million. That's a 9.8% decrease month over month.
Yeah.
That's horrible. Okay, but we have home builders rallying today. What's happening with U.S. housing right now? I saw a report this week that there are 5 times as many sellers right now in the market as buyers, a level with which we have not seen since the global financial crisis.
Well, I mean, obviously, we've talked at very extensive length for months and months and months about what the 2022 rate hike cycle did to the housing market, which was basically lock it up for both sellers and buyers. It locked it up for sellers because if you have locked in a mortgage rate somewhere near the national average of 4-ish% or lower, 3.5 to 4 or so, then why in the world would you be cavalier about refinancing at rates twice and 3 times what you may have locked in as your cost of money? So sellers haven't been enthusiastic about selling. That, of course, has kept inventories very, very low because U.S. housing supply is about 4 to 1 existing homes versus new. And we can have a tremendous conversation about all the many ills that can be addressed if we built more housing. But that aside, if you consider for the home builders calculus here, obviously mortgage rates have unclenched a little and people have kind of acclimated to where they've been hovering recently. And so more people are selling, more supply is coming on. The prices will adjust eventually. Housing markets are notoriously very, very slow, and the price adjustment has kind of already started. So now, if you're looking at the home builders, on average, it takes about a year, about 12 months to complete a single housing unit. So if you're a home builder and you say, okay, well, whatever's happening here, we probably get a surge of interest from buyers, and we're going to have inventory for that in about a year's time. So, okay, let's go build it. And if the market is looking at that and that's what they're anticipating, then what we see in ITB starts to kind of make sense because the markets go, okay, well, it's not like we're at the end of a price adjustment in housing. We're in the beginning stages and it takes a long time. So for home builders to get ready for what buyers will want to do once they notice, they should be starting to get inventory together right about here.
Yeah, the housing story is not really a national housing story right now. This comes from Resi Club, Lance Lambert. It's using the Zillow Home Value Index through May 2025, which was published earlier this month. Glenn, you and I, people are feeling the squeeze up here still. House prices keep going up in the New York and Chicago metro areas. In fact, in my area, quite dramatically, which I'm not shocked about. My wife works in real estate. Pre-pandemic, May 2019, there were 6,400 active listings in Westchester County, just north of New York City. Currently, they're about 1,600 for this time of the year, which is really odd because everyone puts their homes up for sale in the spring. So they move during the summer and their kids can start September, the new school year. Everyone's settled in, right? So you can see in New York, housing inventory is just non-existent. So prices keep going up. It's going up in Chicago. It's all the places that really built up a lot. Feels like an echo of the financial crisis, Ilya. Las Vegas, Phoenix, Austin, Portland.
Yeah.
Parts of Los Angeles, parts of San Francisco. Right? So look at lower Florida, southern Florida. Anyway, it's not a one size fits all, and that's what's so interesting about how the Fed proceeds here. Because unlike in 2007, 2008, where it was the opposite of a rising tide lifts all boats, it was a falling tide sinks all boats. Everything came down, right? This time it's not like that. It's the areas that saw the significant overbuild post pandemic. Those are the ones that are getting hit hardest. This seems like it's just going to go on. You said that the bill is going to come due at some point down the line once the rate hike cycle started. It feels like it's coming due for large portions of the country in the areas where you have the most significant housing market activity.
Yeah, it's starting.
Well, why are Austin home prices falling so much? Why are rental prices falling so much? Because they built so much supply. So here in New York, in Chicago, Glenn, got a very different calculus. There was no overbuild. So where's the excess supply to get rid of? Just doesn't exist right now.
Or build. Never mind overbuild. Just build.
I would like to say that my town is doing a great job on this. They've just approved a lot more housing, and 100 new units are coming into town. Taking the steps. After when I moved here, up until at some point of October last year, only 2 units had been permitted in town in the 2.5 years since I moved back home. So things are changing.
Has changed as well. Our new mayor, Daniel Lurie, has been really pushing this subject. And frankly, his predecessor, London Breed, likewise. There's been a consensus that's emerged that the way you bring down housing costs is gasp, shock, build more supply because more abundant things cost less. It's an incredible realization. But here we are.
Impressive.
Better late than never, I suppose. And so we're starting to see that here as well. The tide is shifting.
And you brought up one interesting point, Ilya, that you don't think mortgage rates have all that much to do with it now, just because a function of time, because it wasn't expected for a couple years, and now it's looking like the new normal. So change in that regard
doesn't down off the high highs.
Mm-hmm. But I'm saying there doesn't necessarily have to be such a dramatic spark there anymore. It lies in other. Okay, interesting.
Yeah, I mean, I think you have to remember how slowly the housing market evolves. So if we consider the sort of the extreme example, stocks bottomed by March of 2009. Housing wouldn't bottom by late 2011, early 2012. It takes a long, long, long time to clear the housing market. And it is frothy here by any stretch of the imagination. So we've had mortgage rates come in. I mean, obviously, they're a little bit lower. The Fed cut rates by 100 basis points last year. It's not surprising. They're expecting to keep cutting. We're quibbling as market participants about 25 basis points here or there. But from a mortgage rates perspective, rates are going to be lower, and you've had the benefit of time. So if they're settling a little bit higher than they were, or than really they would have if the Fed kept cutting, there is sort of the dual thing of we've seen mortgage rates higher in the past 2 years, and they're sort of anchoring in a way that people are getting acclimated to seeing. And we're seeing that, I think, in relatively equal measure, get some of these sellers off the fence.
You can see it's a total tale of two cities. Real estate isn't created equally. For example, the Schwab REIT ETF, the Real Estate Investment Trust ETF, it's been chopping around sideways here for the past few weeks, whereas the home builders themselves, they've kind of keeled back over and started rolling back over again. I'm thinking about this just for myself from like a personal, little bit, not necessarily a trade, but like a longer term portfolio construction perspective. Housing is historically one of the best places to hide if you're going through a period of inflation. Housing that's built, in fact, not housing that needs to be built. And so these real estate investment trusts, they can get very regional specific. I can go and find a REIT that is just about New York City. I can find a REIT that's just for Nashville, or a Southern Sunbelt REIT, right? So where you choose matters. And that's why I bring up those charts, because as I think about some of the allocation for housing plays, the home builders don't look like they're getting any love right now. And in this environment where labor supply is in question, where the tariffs for the supplies for aluminum, for copper, like all this is in question, and mortgage rates are near 7%, what are the home builders going to do right now? So I would think that if I want to have a housing play on the board, housing that's already existing, party that's already built, that would probably be the one to look at instead, as opposed to the home builders. Unfortunately, that's just where we are right now in the cycle. I don't see it getting better. You can see JRE, the Janus Real Estate Investment Trust ETF. This too, similar pattern. This looks like a big, all sorts of a flag to me, Ilya. I see everything as a bull flag, though, given my my delusions of being a bull. So,
if it's a bear market, then it's sideways consolidation. If it's a bull market, then it's a flag.
Yes. In stocks,
easy
yes.
Playbook.
Got it.
Could do this all day.
Yes. Yeah, right. Yeah.
Show me another
Captain
chart.
America trade. Okay, so more consolidation here, Ilya. We haven't touched on metals yet. Mm-hmm. Actually, Glenn, let's go to you first. If we're talking about the potential dollar bottoming, it is worth discussing the positioning in gold. In that same global fund manager survey that showed fund managers are the most bearish on the US dollar since January 2005, long gold is the second most popular, is the most popular trade on the board right now. It's long gold, long Mag 7, short USD. And so if the dollar is going to rebound, these dollar-denominated assets probably have a little bit more of a difficult time rallying. What's your view on gold, on silver? Do you see a difference between the two of them? How do you approach these markets as a more of an FX person, considering it is a dollar-denominated instrument?
Yeah, I think it's been quite a run. And so on the backdrop of a Fed announcement like this and seeing the knee-jerk reaction here, and especially in cryptocurrencies, it's coming front of mind again that, a high interest rate environment, really not good for crypto. And so in my mind, you could argue that even though it might be a crowded trade, all these long gold positions, not really any indication that anyone needs to, mass liquidate and go somewhere else. I mean, you still have all the fundamental storylines behind why you'd want to keep this on. And so it's hard for me to find momentum to the downside in this market unless something really falls apart. And you start to see kind of an unwind, because I feel like there's definitely, given how this asset can be leveraged, there's definitely an unwind risk here, but also very hard to make the case that this could keep running. So, the market structure over the past now over a month, really speaking to, we have settled in here. It isn't like we're in uncharted territory anymore, and that 3,400 is a ridiculous price. And so a sideways market here isn't ridiculous to expect. That's how I'm treating it. Metals in general, I feel like you have to have a lot of conviction to play them, and it's hard. It's been hard at these levels, and you've gotten an opportunity in something like silver or platinum to play the catch-up game. Those ratios definitely have been interesting, but other than that, not too sure. What are you guys thinking?
Hey, platinum's been wild. Westwater pointed this out to me today. I saw that it was doing really well this year because it's up like 49%, or 46% right now. Actually, I want to just double check that. I don't want to. This is not the forum to spread fake news. There's other forums for us to spread fake
Vecchio
news.
said.
Yeah, right.
What Chris said.
Dangerous. 46.18% higher year to date for platinum, but on a 3-month basis, it's up 29.99% this quarter.
Yeah.
So a lot of these miners have had a really, really, really good run, which gold, for what it's worth, it wasn't really down that much today. Then it flips and now it is off by 0.64%, dips back below 3,400. Some of these gold miners right now, perhaps bad news for one Victor Jones, who I'll be speaking with later today on The Price of Truth. These look like they just ran into significant highs as gold looks like it's having trouble rallying. The dollar looks like it's bottoming. And now the miners are up at levels where we've previously had significant resistance and we're failing around them. Maybe that's the short-term play here, right? Why do you want to hold on to the miners if gold's going down, if silver's going down? You really don't. It's a high beta thing.
I wouldn't go so far as to say silver is going down or gold is going down. I would say both appear to be consolidating. Silver has a breakout here through the range around 36 or so, and it's holding that very firmly here. In fact, on the test today, after yesterday's rally, you're kind of narrowly holding yesterday's resistance as support. So this does not look like anything that's rolling over. The situation in gold is not very different in the sense that while gold is relatively more staid here than silver, it is still in a very well-defined up move. Even sort of the most recent up move, if we look at just the low from mid-May, you're holding former resistance as support here again. Now, you are starting to test a little bit deeper under it here today, not dissimilar from some of the deeper testing higher in the dollar, but just like that testing higher in the dollar, I would argue hasn't produced a conclusive breakout. Neither has the testing in gold. So I think at this point, it's tempting to want to draw a narrative here, but I don't know that you have one yet. I think so far you still have a similar set of circumstances, which is the trend is up. Nothing is telling you that it's turned. It does make sense, certainly, to be on the lookout for a turn because you're at very significant barriers. I mean, obviously, 3,500 is a very key line in the sand here for gold, which makes it all the more logical that the market is stalling here, but also possible that it ultimately does more than that. So, as with the dollar, I don't see a reason to get long. I don't see a reason to get short gold, but I do see a reason to be very, very vigilant about making those adjustments because they really could be here. They're just not confirmed in my mind. So I'm still long gold. I'm still short dollars, but my trigger finger is itchy, and I might very quickly flip the other way.
So no metals, no metals catch-up play for you. In my mind, that's been the narrative in recent weeks. Is all these other metals exploding? Has that run its course?
I don't know. I'm of the mindset that there could still be catch-up towards gold, right? Because I mean, look what's happened at platinum here. Platinum's gone. It's unfortunate. I guess I can do this. Platinum's gone absolutely nuts. XPT, USD. We'll just.
It does have a tendency to do that every now and again.
right? This is
Every now and again, platinum just goes completely haywire. There we go.
right. You're talking about this huge. Let's get the seasonality off there. This has been a huge advance over the past few weeks. We were below $900 an ounce, now above $1,300 an ounce. But that's the catch-up play here, where everyone is saying, okay, gold's run up. It's too expensive for me to buy gold at these levels. I'll buy other hard assets. I'll buy the other things that I can get my hands on that have tangible value as opposed to being digital ones and zeros. Which I suppose it should be the last thing we talk about today. We briefly touched on coin earlier during last call. It had a really nice performance today as the Senate passes the Genius Act, 16.3% higher here, outlines regulations around stable coins, which has been a promise of the Trump administration going back to the campaign. So promises made, promises kept, I suppose. Interestingly enough, as this passes, right, what's getting hit the hardest? Visa. Visa is getting hit pretty hard. MasterCard is getting hit pretty hard. What's Amex? Why am I forgetting Amex's stock ticker right now? Someone throw me a bone. Amex stock ticker.
Isn't it
AXP? Yeah. Okay. Why am I thinking Amex? It's totally lost my mind there. Amex different group. Amex is a different group here because, well, it's a different client base. Stable coins really impact everything else. Stable coins are really more about what happens with lower income consumers. It's one of the concerns that actually around Walmart right now. Walmart's announced intention to have its own stable coin come out. And it's seen as competition for potentially, regional or community banks, for some credit unions. But you see the stablecoin news passed today, or stablecoin legislation passed today, and Visa and MasterCards are the one that are hit the hardest. So why am I raining this out? Ilya, we talked Bitcoin briefly on last call. So Glenn, we haven't seen anything in Bitcoin here today as a result of this legislation passing. But it is, again, a dollar-denominated asset. So if the dollar is going to bottom, then Bitcoin may struggle here some. What's your take on the crypto market these days?
Yeah, I mean, I touched on it before. I think around Fed announcements, I don't know why it feels like there is just more of the sentiment around, higher rates. When we really see a bullish cycle in crypto, it is in a low rate environment. And so I think that may be hampering things today. Definitely hasn't gotten any sort of safe haven demand around these events as an uncorrelated asset. I would have expected this good news to be good news for Bitcoin. But again, it's so early in my mind, especially around, I think it's a very simple math equation to say stablecoin approved directly impacts Visa, directly impacts MasterCard. But I am a little bit surprised because none of this has actually played out yet. And so I think it's very early on, and you don't necessarily know who the winners will be. This move in anticipation that stablecoins will crowd out those companies, but I think there's still room for everyone to adjust, and you don't know from a corporate level who will come out ahead as a result of this technological advancement.
Oh yeah, I'm still real bullish. I know I flashed this chart up earlier on last call with all these Fibonacci lines drawn. I know I can't help myself sometimes, but tactically, this looks like a really interesting trade if we're able to punch through 110. Where you've had this just basically 70, we'll call it 74 up to 110 range since November. It's been a 6-month trading range. The extension
got nowhere for 5 weeks here at the top of this thing.
But if we start to get moving, the measured move is up to over 135,000, which is why I'm so fascinated with what's happening in this consolidation, because there is that little voice in my head that says we just had a rally off of some low.
Is it a bull flag, or is it a triangle?
Like, what's going on up here?
Yeah,
is that continuation? Bottom left to top right?
We'll see.
Certainly looks like it.
I think I wouldn't be surprised if as psychological as it sounds, the 100,000 level to me right now is really interesting. In a bullish environment, I still wouldn't be surprised if we saw it flash there. I mean, the inclination is if it goes through that, then maybe we enter a different environment. But I still think from a unique price point perspective, I agree with you that we could see anything from 100,000 to 110 and nothing fundamentally changing. That's just the way it's been moving with so many other asset classes at the front of the picture. So
I've said this before. Perhaps the chat wants to chime in here too. Does it feel different this time? I just do not see the people cheerleading crypto in the same manner with which they did in the fall, winter of last year. Right? I'm not seeing the obnoxious videos of people on their boats in Miami. I'm not seeing people at clubs. I'm not seeing ridiculous fundraising rounds. This is the quietest rally in crypto so far.
That's because, you know, all the smart people that may or may not be myself are trying to play Ethereum, and that is not near its highs. Those unnamed traders couldn't go to the club or get a yacht.
Okay.
based on this price action. So, Chris, maybe they just don't have it this time.
That's true. I mean, whereas Bitcoin is sitting right just below all-time highs, we're not quite at the halfway mark, but, at near $2,500 ETH, you're still well a ways away from $4,200 an ounce.
Yeah. And the fall, which you called out before. I mean, that a remarkable run.
It certainly seems
here a run as well, but definitely more consolidation and not remotely to the levels we saw 6 months ago.
No. It sort of seems like the idea that the rising tide lifts all boats in crypto is out the window as the asset class matures. I suppose that's good news, but because it tells you the market is getting deeper and more liquid and more differentiated, as opposed to just blindly hodling everything. But
blindly hodling on a long enough timeline has worked out, Ilya.
It has, and
I think it's 2 years now. I think if you hold Bitcoin for a minimum of 2 years, at any point in time, you've been guaranteed to make money.
Completes the cycle.
I mean, I maintain that digital tulips will eventually turn out to be as such. And by the way, I'm quite bullish on the technology. I just don't see any reason to be bullish on the token itself.
I know you like the ideas of cars. You don't like the Model T.
Yeah. I think the grand application here is CBDCs, and
which Trump spoke about favorably today.
Yes,
by the way,
yes, and that will be the great triumph of crypto. I think it's a disruptor to the banks and the credit card companies and other kind of payment infrastructure names, not so much to currencies.
That was mentioned that the U.S. needs to beat China in the realm of digital currencies moving forward. And that when they say the U.S. needs to beat China, this isn't like our American private companies need to beat the private Chinese companies. It's the United States government needs to have control over the digital asset space before the Chinese government gains that leverage and control over the digital asset space. So
unconditional surrender.
Parentheses.
Speaking of unconditional surrender, we have done a pretty darn good job not getting too far in Israel, Iran here today. But it is worth mentioning because this is the big elephant in the room here for the next, we'll call it 25 hours and 2 minutes until the futures market opens tomorrow.
Yeah.
95.5 IVR. We gap open higher. We close a little bit lower from the open, but we are still above yesterday's closing level. We are well off the lows, in part because Trump said that he was getting calls from Iran to come to visit the White House to negotiate, which the Iranian consulate for the UN came out and said that they will never grovel at the gates of the White House. And there was a whole bunch more, but I think that first sentence really captures the mood.
Yeah.
So for the sake of timing here, Are there negotiators in Oman right now? Perhaps. We did have a news headline earlier today that Iranian negotiators are heading to Geneva to meet with European counterparts on Friday this week. So signs of off-ramps persisting, they still exist. If the bombs don't go off tomorrow, you probably see a little bit of a vol crush. Once the market opens up, people are relaxed. They can unload their positions that they held as a hedge. And then we get to a Friday where, all things considered, if there was no volume today with the FOMC ahead of a holiday, of expiration, OPEX around the corner, Friday might be a pretty dead day too. So position management, maintenance, that's the plan.
Spot FX still open tomorrow too, though. So if you're looking to monitor something.
Is where I wanted to end here, Glenn, which is perfect for having you on, because spot FX markets, unlike even the currency futures, they will remain open. And so you can look to things like dollar yen or Aussie yen or the euro to kind of interpolate how equities or bonds may be behaving, broadly speaking. Because if Japanese yields are up, but the dollar yen rate's trading higher, then what does that mean about U.S. treasuries in the futures market? They're probably going to open up weaker, higher yields, right? In any event, watch the market open tomorrow, 6 p.m. Eastern, 5 Central, of course. I'll be back later today for the Price of Truth with Victor in about an hour's time. Ilya will be back right after this for Macro Money, so stick around. I want to thank Glenn Freiberger for coming back on again here, joining us in Overtime.
Thank you, guys.
We'll see you again soon. So for Glenn and Ilya, I've been Chris. Good luck trading. Catch you on the other side of a quick break. You're watching Tasty Live.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new tastytrade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
I want to play a game. It's a relationship game. So I'm going to ask you each a question to your partner.
Who loves the hardest?
Yes, yes, yes. So are you ready?
Exactly.
Who's more stubborn? Who's more public? And who do you think takes longer to get ready in the morning?
Oh. He's gonna do his hair.
Who's a better driver?
I mean, for sure.
Yeah.
Like I live in Italy.
Yeah.
Like we drive like
I drove a truck in New York City.
I drove a tractor on a farm. I can fly an airplane.
Who loves the Fed most? Who is more spoiled?
Oh. It's not even close. Like you got buildings full of people. What do you want, Mr. Zosnoff? I have nothing.
Crypto is better when it's tasty. The Tasty Crypto Show, hosted by me, Ryan Grace, and Frank Caverna, will help traders of all levels learn DeFi trading. We'll provide our insights on altcoins, crypto industry news, and blockchain education. And we'll have you swapping, staking, and trading using derivatives in no time. all using the Tasty Crypto Wallet app. So don't fork up your chance to become a crypto master. Watch Tasty Crypto only on Tasty Live.
What happens when two titans of trading come together to harness the power of their prowess? Yes, let's watch these two dominate this popper shop. Wait a minute, I thought these guys were traders, not contractors. They're putting up a lot of bricks. Well, lucky for us, Tom and TP are better at writing than they are almost anything else. Subscribe to Tasty Live Cherry Bomb to get piping hot takes on the market delivered right to your inbox. Sign up at tastylive.com/newsletters.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Tom, when you talk about the good guys, who are they?
They are us. We are the good guys.
When you say they take out the weekend, what does that mean to you?
That means when you're a premium seller and they take out the weekend, that means that all the decay over those 2 days, Saturday and Sunday when the markets are closed, come out of the market Monday morning.
When I say bell to bell, what does that mean to you?
Bell to bell is like in horse racing, they would call it wire to wire. And in trading, they call it bell to bell. So the opening bell to the closing bell.
If you're saying something's thin, what does that mean to you?
That means it's not very liquid. That means that the marketplace is relatively illiquid. That's what thin means.
If you can't buy an uptick, what's happening?
If you can't buy an uptick, that means the market is going down and there's no bounce.
How does Daddy do it?
Daddy does it good.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Well, the Fed has come and gone, and doesn't look like we're very much wiser for it. No major changes here as expected, not only for the Fed's overall stance on policy, that was very widely expected to turn up a goose egg, but the situation for the forecasting that the Fed offered pretty much as you might suspect, and as we discussed on the show here yesterday. But some interesting things showing up in the expectations, and of course, a very interesting path forward now that this is out of the way. This is Macro Money. I'm Ilya Spivak, head of Global Macro here on Tasty Live. And we are going to go through all of this here, taking a look at what the Fed did, how that fits into the overall story for investors here, and what is on the menu next. So first, just to look at how the day finishes here for financial markets, it is quiet to say the least. Stocks ultimately go nowhere, neither do rates. The situation for gold is a little bit spicier. It is a little bit lower here alongside crude oil, so perhaps a little bit of a moderating geopolitical take here emerging in markets. But the dollar, steady. Even Bitcoin hasn't gone very far. So the situation fairly stayed. Now, of course, we do have a U.S. market holiday tomorrow, and the closure of the futures markets here is through a 24-hour period, basically, from here until things reopen in the PM Thursday U.S., Friday a.m. In GMT terms after the holiday. But of course, global markets remain open. So we'll see what happens here in the wake of this Fed announcement for how it is onboarded in Asia Pacific markets, and then, of course, in Europe. That's not necessarily going to move U.S. assets because they will be closed, but currency markets will be on the move. So perhaps we'll get a sense from the likes of the euro and the yen what all of it might still mean. Looking at the statement from the Fed, very little has changed here. But what is interesting is this little bit in the second paragraph where it says uncertainty about the economic outlook has diminished but remains elevated. Anybody that might look at the S&P 500 since the lows of Liberation Day in early April might agree that indeed uncertainty has diminished. In fact, we see that show up in survey data as well. The PMIs have slightly improved. The story in consumer confidence, as we noted yesterday, has very clearly improved looking at the latest University of Michigan numbers. So indeed, worries about the uncertain economic outlook have somewhat eased, but the overall uncertainty still remains and still is significant. So very much in line with what the Fed has outlined here. What's interesting is also that they strike the bit about risks of higher unemployment and higher inflation rising, suggesting that that is a backward-looking statement as of May. But of course, when you look at the summary of economic projections here from the Fed, you do see that sort of a tilt. And of course, as we discussed yesterday, we anticipated as much because in May, the Fed said exactly this, that it has now taken out. And so you have from March, the adjustment in projections giving you lower economic growth from 1.7 to 1.4 for this year, from 1.8 to 1.6. Next year, we can see right alongside that unemployment marked up versus March, and inflation marked up as well. So this seems to suggest that things haven't become worse in the Fed's thinking between May and June, but they have become more so concerning between March and June. Because, of course, in May, there was no update of the summary of economic projections here. So for inflation, higher inflation across the board, across the entire 3-year view here, both headline and core. But perhaps the most interesting part of this story, the part that we didn't necessarily anticipate, because, of course, all of these changes were very clearly marked, if not necessarily in their magnitude, then certainly in their direction, in what the Fed has been saying, both in the policy statement in May as well as the minutes from that meeting that came out sometime later. This is a little bit different. What we see is that for 2026 and for 2027, the stock of rate cuts has significantly diminished. And what we now see is that while we, in March, we're still looking at 100 basis points between this year and next, and then further easing, another 25 basis point cut in 2027, we now see the timeline elongate. So we still get the 50 basis points this year from 4.4 to 3.9. But then for next year, it's 3.6, so one cut instead of two. And then you get to 3.4, one more cut in 2027. So you get to 3.4 as you were anticipating, but you get there later. Get there a year later, as a matter of fact. And so the Fed here is signaling that actually after this year, scope for rate cuts is diminished, not increased, which is certainly quite a bit different than what you find in the market's own expectations for what is likely going to occur here. And actually marks what is probably the most interesting sort of upshot from the Fed announcement here writ large. So you have here the path for this year, and not surprising, it hasn't really changed very much. We have standstill through July. You start to kind of flirt with the idea of a cut in September, October, and then another one in December, and that's how you see the markets basically lining up with that 50 basis point forecast that the Fed is giving us. But when you consider what's going on for next year, the easing is actually expected to get more intense, not less. So whereas the markets are now at 100 basis points, the Fed has gone down to 75 over this same time period. And this now makes for a very interesting dichotomy. Because if the market is in fact going to say that, look, the Fed is worried about all of this uncertainty, they're worried that the cutting of rates now would be premature in the event that tariffs, as they work their way into inflation, do end up inflationary, and growth is impacted negatively. And through all that, the Fed has competing objectives, so it doesn't want to jump the gun. It really wants to make sure it's doing the right thing and focusing in the right area of the economy, whether it's focusing on inflation or focusing on growth, and justifying the standstill by saying, well, look, inflation is 2.4%, looking at the latest CPI numbers, and the unemployment rate is at 4.2%, which by historical standards is very low. So inflation is within a hair of target. Unemployment is very healthy, historically speaking. And so why would the Fed want to try to reconcile what the tariffs are going to do before they have evidence? Why would they guess? What is the impetus for them to do that? Why not just say thank you for the relatively well-positioned economy, and as they have, invoke that you have the benefit of time to wait for things to really tell you which way to jump without a need to rush it? Well, the markets don't have that ambiguity. They don't share that kind of confusion. They actually seem to have decided that they know which side of the coin this is going to land. And we've talked about this before, but we'll bring it up here again. This is the look at inflation expectations baked into the bond market, which we can see from mid-February were falling with stocks as the rollout of the White House's tariff efforts stoked concerns about economic growth and those efforts' consequences, negative as the markets judge them to be. And you see that come April, when you get that kind of back and forth, you get Liberation Day and then shortly thereafter a 90-day pause on its worst, most economically damaging aspects. You get a very rapid recovery in sentiment. This is, of course, that diminishing uncertainty that the Fed is talking about. This is the S&P, and it's going higher here very clearly. But inflation expectations don't follow suit. They diverge. They are saying that having fallen here, this is the place to be. And that, of course, suggests that there isn't a great inflation scare downwind, and that the markets are much more concerned with the growth implications of what's going on and expect those implications to be more powerful than any read-through into inflation, because the demand destruction from the slowdown that the markets are envisioning will overwhelm inflationary forces from higher tariff rates and actually result in inflation being net lower. And that's the story that we've seen here really since mid-May, evolving after this larger move since the beginning of the year. So it's no surprise here that the markets are at 100 basis points, even as the Fed goes to 75. And so what this does is it opens up a very interesting sort of possibility for a revaluation in markets where they become convinced that the Fed is behind the curve and move forward with pricing out more aggressive rate cuts downwind, expecting the Fed is going to have to play catch up. A similar outcome last year gave us a dramatic rally in the bonds from April into September and a parallel sell-off in the dollar too. Now, beyond the Fed here, which was limited to this little bit in terms of its kind of practical deviation from expectations, we have a monetary policy announcement coming up from the Bank of England. No changes expected here. We can see rates seen steady in June, but the markets do anticipate that the bias will remain dovish. You can see here there's still 44 basis points on the menu for rate cuts this year and another 27 basis points next year. So the markets are very much still looking for the Bank of England to be cutting. In fact, you can see here when you have a cut on the menu somewhere by September and then a further one in December. So if we take a look at the pricing here, it's not impossible that we may go as soon as August, but certainly by September. And so that's really the market moving component here. We just had UK CPI data. It came in a little bit from the 15-month high, largely as expected. And if we look at the breakdown, a nice swing lower in transport inflation, most things still stuck in this energy component. But as we have talked about before, this is mainly a change in vehicle excise taxes, not necessarily a lasting sort of thing. This is more a function of policy, not of economic dynamics. Probably the biggest bit there is food and the increase there. But of course, that move really is outside the purview of what the Bank of England has agency over. It can't mandate global food prices or energy prices. And what it's dealing with then is seemingly the kind of thing where they have mostly a fiscal policy shock and just need time to work through that shock, filtering out of the data. That likely is how you end up with the dovish perspective in markets, because of course the growth story in the UK is pointing toward deceleration basically since the middle of last year. Things have perked up just a little bit here in May, but the economy is basically at standstill when you look at it in these S&P Global PMI terms. As ever, of course, these numbers are centered around 50, which is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And at 50.3, you're essentially idling, with manufacturing in contraction mode and services growing by a hair. And the trend, as we can see here, has been toward increasingly slower economic activity growth. So with that in mind, that dovish bias at the Bank of England seems to make sense, even as they pause this time. So the key risk then becomes that the Bank of England decides that actually, with the surging cost of oil around conflict in the Middle East and all manner of other potential influences here, the bias might be less dovish than market pricing suggests. That maybe they have less room to think about rate cuts for the rest of this year and maybe next. And so if that's the case, if the Bank of England seems to sound a little bit less dovish if the voting tally is a little bit more hawkish of a hold than what's anticipated. So the markets are looking for a 7-2 vote on the 9-member Monetary Policy Committee in favor of a hold. If it's, let's say, 8-1, where only one person calls for a cut rather than two, that would clash with market expectations. And against that backdrop, the British pound could have itself a little bit of an upside run. Most other markets, of course, closed, so not much to see outside of spot currency markets and, of course, local European equities. But in this environment, it's really spot British pound where you'd see kind of the meat of the impact of something like this. And then looking ahead, because we don't really have much in the way of event risk beyond that this week, first thing next week, as we come back from whatever diminishing volumes after the holiday, we get S&P Global PMI data for June, the first look there. And immediately you get a sense of a familiar divergence. So the composite index taking in both services and manufacturing for Japan, expected at standstill, just a hair above 50. For the Eurozone, standstill, just a hair above 50. For the UK, standstill, just a hair above 50. For the US, clearly stronger growth. And so once again, you have this resumption of a world where it's the US or bust as far as global economic growth is concerned. We, of course, pointed out repeatedly that global growth is basically made up and is basically driven by three major economies: the US, the Eurozone, and China, with the US being the biggest piece. The rest of the world, the remaining 42% outside of the 58% made up of the big three, they're mainly vendors to those big three and depend on their demand to have demand of their own. So it's really those big three setting the course of where things go. And if we look at what that's meant, it is been a slowdown in global growth, really going back to the middle of last year. These are global PMI numbers here, and there's 50. So we can see manufacturing is back in contraction mode, where it's been flirting for quite a while. But the overall story here, the composite index in the blue line here, it's been steadily decelerating now for almost a year. And so we're at this point here where in May there was a little bit of a pop, but off a 17-month low here. So the story is of weakening overall, and the disparity, the duality of what the expectations suggest has really been how that's occurred. So we can see here the U.S. economy over that same period has been relatively strong, but the other drivers, both China and the Eurozone, have stagnated toward standstill at best, and in the case of the Eurozone, a mild recession at the end of last year and going into this one. But both are now basically standing still. And the U.S. is outperforming again after diverging down here, but that may not continue. And if it doesn't, then there's really a single point of failure here. There is no safety net. If the U.S. slows, then so does the global economy, and then global recession risk returns, which makes these PMI numbers early next week very interesting indeed, because as it happens, U.S. economic data has increasingly disappointed relative to expectations over the past 4 weeks or so. We can see that the Citi Economic Surprise Index here, the global one is being pulled lower. The G10 one is being pulled lower. Meanwhile, the Eurozone's data is steady, And of course, in emerging markets, things are steady also. So the pull down here on the global and on the G10 readings clearly seem to be coming from weakness in the US. If that is going to foreshadow a disappointment on these PMI numbers, then global recession worries may well return in spades, even as the Fed gets an ever-widening wedge between its view and the markets, where the markets are more dovish and the Fed is less so. Not exactly the most encouraging setup for risk-taking and stock markets, of course, if this plays out as it might. That is macro money for today. As ever, we are here Monday through Thursday, taking, of course, the holiday off here on Thursday with markets closed. So this will be our last show for this week, back to our regular schedule next week. And back on Futures Power Hour Mondays and Fridays, back with Victor Jones for The Price of Truth on Tuesdays, on with Tom and Victor for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Finding where markets meet politics, if you will, is kind of a passion of mine. We're changing cycles right now. We're moving into a different political complexion down in Washington, D.C. We're moving into the end of a potential Fed rate hike cycle. And as you change these economic and political regimes, asset prices behave in different manners. So I do think what's worked over the past, say, 1 or 2 years may not work so well in the future. I have like a kind of a core satellite portfolio mix where I keep some assets for multiple months, even quarters, years at a time. But then I augment that with some options trading in order to help provide a little bit more convexity to my portfolio. Risk management is the most important thing. You can't control where the market's going to go on a day-to-day basis, right? No one individual investor has that capability. But what you can control is where you get in the market, where you get out of the market, how big your position size is, and learning that the market is not always going to move in your direction. You have to appreciate the fact that you will make mistakes, but the idea is that you make enough of these trades with a consistent enough edge that over time, as you stockpile some results, then ultimately you are profitable over the long haul.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Global markets never sleep. Explore them with Forex, now available on tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, fellow Crypto Cave member, Dan Cecilia. Dan, what's going on, my friend?
Nothing much. Happy to be here. Market's taking a little bit of a breather. Crypto market specifically, I think.
Yeah, what the hell?
A bit of a breather, yeah.
Not a
I don't
fan.
know what's going on here. I thought we'd be at a 200K by now.
I was hoping the same. We're going to talk about that in just a second. We've got a performance dashboard. We'll talk expected moves, kind of go around the horn here, take a look at some headlines. We had a Fed day. I don't pay attention to much of any of that anymore. I think the probabilities were basically zero of any interest rate cut, at least for right now. I think there's still 2 cuts priced in. I suppose maybe I do kind of pay attention. 2 cuts priced in for the rest of the year. I didn't see anything, and my internet connection doesn't work over here either. So I don't know what's going on, man. Did you see anything? We had, some legislation passed, possibly? The chat's blowing up.
Genius Act passed. So
Okay.
stable coins are now, there's some regulatory framework for US dollar stable coins. So now all these kind of representatives, Sachs, Besant, they're saying that stablecoins can reduce debt costs. Besant, I don't know, Scott Besant. Stablecoins are a $3.7 trillion market opportunity by 2030, Scott Besant. And then Genius Act extends dollar dominance. So those are some quotes from representatives.
Well, it's good when you have the U.S. Treasury Secretary or the Secretary of the Treasury. I don't know what the exact formal term is, but when he's pumping it.
Right.
That's
we
good.
want that. We want that.
Absolutely. Yeah, I'm excited about that. Look, we thought that, and I don't know if that's been signed yet or kind of what stage that's in, but passing in the Senate, is that right? Very, very close.
I got a ton of stuff on stablecoins now. JP Morgan piloting stablecoin on Coinbase's blockchain. They're going to call it JPMD. Let's see here. And then Coinbase or JD.com applying for stablecoin licenses globally.
Okay.
And then Coinbase is seeking approval for tokenized equities. So those are some news items, I guess, that.
Yeah, that's huge. I mean, look, you're going to see this everywhere in terms of financial institutions looking to participate. Clearly today we have some first movers, Tether, Circle with USDC. I'm sure the stock price is up as well on this news here.
Yeah, I mean,
Circle Internet Group straight up, Dan, $200 a share, just shy of it. And so, yeah, this is huge for the industry, right? It's going to pull in more liquidity, capital that's on the sideline. I think this is big for treasuries, real world assets, right? There's this narrative in the market where, people are concerned. Who's going to buy the debt? Who is going to buy all this issuance from the U.S. Treasury? The Japanese are dumping, my friends. The Chinese are dumping. Nobody wants this debt. I think when you look around the world, emerging and frontier markets, dollar-based assets, and if you make it a lot easier to access these assets via blockchain networks, via stablecoins, which clearly stablecoin regulation here in the U.S. and presumably the global harmony that follows that regulation, that will bring a lot more liquidity and a lot more participation on chain in terms of treasury investors.
Yeah, for sure. I think that's why everyone's behind it, right? I think they know that. So, have you looked at the stablecoin market cap dashboard?
The last I checked on DeFi Llama, which is a great source for this, and we can pull it up in just a second, but I believe that we had a total market cap of close to 250 billion. I think about 70% of that is probably Tether, though the market cap of USDC has recovered quite a bit post that 2023 peg when we had the whole regional banking crisis.
Right.
But I don't know exactly where we are. Let me try to pull that up here.
Yeah, 251.686 billion USDT. That's Tether, 62% of the total market cap, or the Tether dominance there. So here's DeFi Llama. If anybody watching is new to this space and you're interested in monitoring some of these DeFi protocols, seeing what's happening on chain from a more fundamental perspective, this is a great source. Token Terminal, Dune Analytics. There's a lot of dashboards out there.
Yeah, for sure. How about Coinbase stock? I got some people in the chat asking about that. That was up 17% today.
Yeah, I don't have my Tasty Trade platform up here just yet. Let me get it on. Boom. I wasn't watching, haven't had a position in this. Presumably, this is on the heels of the positive news around stablecoin legislation. I think this opens the door to a broader crypto markets structure bill at some point. But yeah, I don't know. Have you seen anything else here around this massive move? They didn't have earnings or anything like that.
I don't think so.
This was intraday.
This has got to be around the news of the tokenized equities.
Yeah, I did see that earlier today. Coinbase announced that you can use stablecoins as collateral for their futures. And when you think about Coinbase, a lot of times we look at this as possibly a brokerage sort of competitor, right? When you interact with it as a retail user, but this is an exchange.
Right.
And hopefully at some point we'll be able to offer some of the products that are available on that exchange through the Tasty Trade platform. When I think about some of the perpetual futures that they've spun up or some of the other derivatives that they're offering, we don't have regulatory clarity in all areas, but Coinbase did just buy Deribit a month or so ago. So on the options front, there's some interesting developments as well. And assuming you get some regulation, that might open the door to a lot more participation on the exchange and a lot more that we might be able to do.
For sure. Yeah, definitely. I just Googled this quickly. I guess they launched stablecoin payments for Shopify. They partnered with Shopify.
Okay, I saw that on the Base Network the other day.
I guess this news for the stablecoin act passing was the catalyst for this, I guess.
Well, and Coinbase has a huge partnership with Circle, as I think everyone's aware if you're following Circle or the IPO. USDC has been supported by Coinbase, and you can use that on the exchange. I use that at times myself. I don't want to make any big announcements just yet, but as we've talked about, and we were in New York just a couple of weeks ago at the StableCon conference, we're working on stablecoins in other parts of this market. It's readily available today. So to me, this is clearly the direction that things are going in. It's the future. It's instantaneous, 24/7 settlement. You look at the existing payment rails today, ACH wire, and I think arguably they're antiquated. You'll be able to eventually on a Saturday, you want to trade crypto, fund your account with stablecoin, you want to buy futures on the Sunday night open, you don't have to wait a couple of days for your ACH deposit to clear or your wire to clear in some cases. You'll be able to fund that, and that money will be readily available instantly.
Yeah, right. Yeah, that'll be a huge unlock for account funding. Velocity of money in 24/7 markets eventually.
Absolutely. As we're talking about kind of the future of markets of trading. And I think what that really relates to is blockchain infrastructure that facilitates this, right? You think about it as a security layer, more so a settlement layer, a little bit more efficient, faster, transparent. You're seeing a ton of announcements around the tokenization of securities. Less relevant, I would argue, for people in the US that can very quickly open a brokerage account with Tasty Trade, for example, fund that account and trade right away. But in terms of access by global traders or users to financial assets, US listed stocks, options, et cetera, the tokenization of some of these securities really starts to open up the gateways or the floodgates possibly.
Yeah. I think it's a total upgrade to markets globally, market structure globally, obviously allowing more participants access to US markets, US listed companies. The US has the largest, obviously, market in the world, most liquid, most active. I think it's all a good thing, right? Because to your point, U.S. citizens don't necessarily, have an issue with opening up a brokerage account and accessing these markets, but globally, people don't have access. So I think this type of innovation and tokenized stocks or 24/7 markets is the future, right? It's where everything's going, and I think it'll be interesting to see kind of what shakes out here over the next couple months. That Circle, you're looking at Circle right now, that Circle stock is interesting because...
Yeah, and shout out to Katana in the chat, said it's up $50 here, and we've got that on the screen. We just had Coinbase up there a second ago.
So what's crazy about that is the market cap of the Circle stock is like $48 billion, and there's only like $50 billion worth of US dollar coin. So it's like, it's getting to a level where potentially might be a little overvalued if you're just looking at kind of, market cap and what they're issuing on chain as far as US dollar coin.
Yeah, absolutely. I haven't paid that close of attention to the fundamentals here. I didn't look at the S1. I'm not an investor in Circle or a trader or anything like that in it yet. But clearly there's demand for access. There's demand to participate in this. And you, up to this point, really haven't had a lot of ways from the traditional side of things to invest in, or there really haven't been US-based crypto companies, right?
Right.
Coinbase, I think Galaxy just went public in the US previously on the Toronto Stock Exchange. You have a bunch of different miners that you could invest in as kind of like a BTC proxy, though not always even correlated, in Coinbase stock, as we mentioned. But you're probably going to see a Kraken IPO. You got the Circle IPO, presumably more are coming. It's a new day for crypto, or at least it has been for a few months here in the U.S. Dan, we got the chat fired up. We've got, they're all here. So shout out to everybody. Lone Sophos, Gregor, Katana. Who else is up in here?
Edward.
Dav, Edward, Emmett.
What's up, Emmett?
If you're not streaming on YouTube, get over there and type some crazy shit into the chat for us. Let's talk about markets, kind of go around the horn here. We sent out our midweek market update email this morning. If you don't get the Tasty Crypto emails, get on the list at tastycrypto.com. Little sign up box there. We send out 2 per day. Sometimes they're jam packed, other times we're busy, but we try to get the signals and the trading ranges and the correlations out a couple times each week with a bit of commentary. I personally enjoy writing some of these emails, but just taking a look at the performance dashboard, you called this out earlier, a bit of weakness. While there's excitement in the market, stablecoin legislation making its way through, crypto company stock prices exploding higher, seeing a bit of weakness when we look at some of the underlying cryptocurrencies, the tokens themselves. What do you make of that?
So I think it's just general pullback from the recent run we had, but I think if I'm looking at headlines here, the Fed left rates alone today, expects weaker growth, sticky inflation. That kind of is a headline that came across. I think we have the global conflict. Iran, Israel could throw some type of, pause on risk assets here.
Yeah, to that point, really quickly, let's just jump over to the correlation so everybody can see kind of how things have shifted in the short term. And that's a great point. If you get, well, long term, it might be completely unrelated. I would argue doesn't really have that much of an impact on, say, the price of Bitcoin on the margin, the events themselves. If you get those risk-off headlines, we've had rising tensions, which have now evolved into tit-for-tat kind of escalation, being lobbed back and forth. You've got Trump now weighing in, of course, on Truth Social or Twitter. I mean, it's ramping up. Don't get me wrong. We thought earlier in the week there might be a bit of a de-escalation, then quickly that was proven incorrect. You're seeing a strengthening in correlations here. So if we do get that kind of risk-off move for one reason or another, I don't think crypto is immune.
Right. Yeah, exactly. I definitely think that if we get a broader risk-off move in the markets, crypto is going to be affected, right? So I guess just pay attention to that. And I just think it's a little bit of a pause. I think we're still in a pretty bullish environment.
Yeah, absolutely.
Broadly.
Structurally bullish. We look at price momentum. We measure that through exponential moving averages and the crossovers. It's a simple way to look at it. It's somewhat backward looking, but keeps you on the right side of the trend, in my opinion. You've seen things go from bullish to neutral for Bitcoin and ETH. Everything else has been somewhat bearish from a momentum perspective for a while. But when I look at the structural trend in place, I want to look at weekly and monthly timeframes. And for Bitcoin, still, it's been bullish. Bitcoin market cap dominance, 65%. Bitcoin volatility is near the lows. In a more bullish environment, I want to see volatility pick up because it tends to rise with price at times, at least when price is really ripping. But we've been range bound. We're well off of those levels from early April, about 75,000. Took a shot at new all-time highs, and we've been, consolidating within that 1 week expected one standard deviation move, given the spot price and the implied volatility. So to kind of set expectations here, your upside is, you could probably call it 112. That's been the recent high that we came off of. But when you look at the current implied vol of 41%, you use a price of, let's call it 104.5, you're going to get about a $6,000 move. It's going to give you 98 on the downside, 110 on the upside, give or take. So well within reason, within the statistical probabilities as implied by the options market right now. It's not uncharacteristic in terms of what we're seeing.
For sure, yeah. I think just pay attention to the ranges. At some point, we'll get a little bit oversold here, and it might be a good spot to go back in and scoop some up. I still think ETH has a good bid on it, maybe.
Let's jump over to the browser really quickly. Take a look at our price chart for Ethereum. There you go. Yeah, just a big move to the upside to start the month of May. And it just seems like we're building that energy, Dan. We're going to go higher or possibly break lower here. But you're just not going to trade sideways forever.
Right.
I'm hoping for the break higher. You got to take out 2,800 and then, maybe the move's back to 3. Maybe it's ultimately to new all-time highs. You look at it this way, which is interesting, and you're seeing the same thing if we go down to ETH BTC. Also looks like, you're kind of priming for a move. This has been, as I like to call it, a very trashy trend over the last year. But let's say that you do run here, the narrative shifts. We know that the real world asset narrative is primarily related to Ethereum. Institutions are building. Stablecoins should start to influence some of that as well or support the idea. And do you get back to 500ths of a Bitcoin? That's going to, at the current prices, imply a $5,000 ETH price. Basically, 100% higher from where we are here today. Now, it's not the 10x that some of us are playing for in other areas of the market, but it's a pretty good return if you get it.
Yeah, for sure. I mean, I think looking at that ETH Bitcoin trend, it's been down only for over a year. And
yeah, look at the 5-year in here.
Yeah, I mean, that's
2022. Really, this time last, a few years ago, was the top, and it's been Bitcoin up, ETH down in terms of that ratio.
Yeah. So, I mean, I think you've been saying this for a number of months now. It's like, might be a good time. So we'll see. It looks like that initial move has happened. Like, it looks like we've bottomed based on that chart, but still a long way to go. I still do think ETH is undervalued based on, like you said, all of the development happening on it. But there's a lot more competition too. There's a lot more stuff that has been developed. It's not the only place to develop smart contracts, trade on chain. So we'll see.
Yeah, the way that I like to look at things at times is to price them either in Bitcoin, and you can kind of find these relative value trades. But when you do that up to today, really, it's been Bitcoin over everything. So on a relative basis, Bitcoin has outperformed, up about 12% year to date. Everything against that is down pretty substantially. But you can look at Solana priced in ETH. And let's just throw our indicators on here for a second. We're starting to see some signs of weakness there too, which to me also signals maybe there's some room for ETH to run here. I look at Solana priced in Bitcoin. That's been bearish for some time. Not saying it goes lower, but that worked until it didn't. And so there's some signs here on a relative basis of weakness in Solana, strength in Bitcoin, some strength in Ethereum. Recently, when we look at the daily here, we were, if I zoom in a little bit, we had that bullish momentum signal, and you can see that it's now shifted to neutral. So keep an eye on that. But ETH definitely trading a lot better. Solana for now trading worse. I think these narratives just kind of ping pong around. But Bitcoin has held up and has been pretty resilient, even though we're whipping around within a $10,000 range. The local low in there over the last couple of weeks have been about 101 for reference. But you're just not seeing any signs in the option market that there's a big move one way or the other that traders are starting to position for. I think that, the Fed and interest rate decision, monetary policy does matter, but we knew coming into this that there was no expectation for any cut.
Right. What are you looking for in the options market? Like, I guess if we take a look at IBIT, is it some big... Is it IV? Like what
Yeah, I'm just kind of looking at IV, right? So if IV is going to increase or decrease depending on whether we have a lot of options buyers or sellers, right? And you think about a market like this where, yeah, sure, the bottom is zero. I don't think we go to zero, but there's typically more upside than downside. You often see this positive correlation with volatility and price action. And because there's that FOMO element and there's a speculative nature to it, you have people that come in, traders that buy up a ton of options on the tail. If it's IBIT, maybe that's in the 90s, it's 100 strike, whatever it might be. And you're playing for that big move and you're playing for that expansion of volatility. Same thing on the downside, right? If we were to start to see a lot of concern in the market and there's some fear, hedging activity, a bunch of traders coming in and buying put options, that's going to drive up put option premiums, put option prices. That's going to subsequently drive up implied volatilities on a per strike basis, as well as our kind of VIX style smoothed calculation when you look at 30-day. You're just not seeing that. What are you seeing? Well, you're seeing the opposite. Here is Bitcoin implied volatility. We're looking at this derived from Deribit. We've got to pull up the Volmex numbers here too. We had those guys on the show. That was awesome. Got to have them back. Let's just look at 30-day implied. Pretty much the same thing, right?
Right.
41%. If you look at this on a kind of IV rank basis, well, your 1 year high is closer to, let's zoom out a little bit. Let's call it about 70, and you're at the low. So your range is 70-40. You're at 40. IV rank of 0. If you're looking for a move in vol terms, maybe you get back up into the 60s, maybe you get to 70 or higher, those options would be a lot more expensive than they are today. So you're not seeing many signs in the options market that traders are positioning one way or the other for a big move, at least today.
Gotcha. Okay.
Now, sometimes that's reactive, and so you need realized volatility to then catalyze implied volatility. There aren't earnings announcements. Obviously, there's event risk at times in crypto, but there aren't earnings announcements where you would see premiums bid up ahead of them. I think it's typically kind of more of a reaction to news. But even with some of the recent weakness, it's not like everyone's rushing to hedge downside.
Right, exactly. Okay, interesting. Yeah, the Volmex and DVol indices are good to take a look at too, just to give us an indication of, I guess, positioning and some of that in the price.
Yeah, here's on the other side though. Here's Ethereum, a little bit different. We'll put our indicators on there. So Ethereum volatility, kind of a little bit more of a bullish trend here at the moment. Another reason why I think, okay, maybe you could see, nothing's guaranteed, but maybe you could see a bit of upside in ETH on a relative basis here. We'd see that ETH BTC ratio move higher as a function of that too. But ETH vol is trending a little bit higher over the last couple of weeks, while Bitcoin volatility is at its yearly low.
Right.
You see that with realized as well. Just kind of going around here, Dan, real quick look at, here's Bitcoin market cap dominance stuck at the mid 60s. No signs that it's altcoin season just yet. A couple tokens that have been a bit of a bright spot. I don't know if you have any insight into what's going on with Bitcoin Cash, man, but Bitcoin Cash just ripping. Bullish.
I have no idea. I've never looked at that before.
You know, you could have bought it at 380 a couple weeks ago. It's $100 just about higher.
Yeah.
We're talking about Coinbase is up $40. Who cares?
Yeah. Yeah, Bitcoin Cash. Buy Bitcoin Cash, apparently.
Another one that's been on my radar here, Aave DeFi lending platform here. We'll just use the Coinbase price. it's pulled back, but another nice move where you got that signal just a few weeks ago back in May. Could have bought this, I think when we first saw the momentum flip, you were closer to about 250 and just caught, a nice rip there up to about 320 or so. So that's another one that has shown some resilience in the face of, when we look at the weekly returns here for most alts that I track or that we offer through Tasty Trade, we're down double digits on the week, and it's been kind of bloody on the 1 month and 3 month basis too. What else are you trading? You buying any NFTs? Like everybody that I talk to is like, what's going on with the NFT market? You're in that space. You got a couple minutes on NFTs before we wrap up?
Yeah, I mean, I am just looking. Well, NFT NYC is next week.
Okay.
So I feel like there's always people that launch projects around that because they'll want to go and like promote it in New York. That's when, for anyone that doesn't know, that's the largest NFT conference in the world, New York City next week. So couple projects have launched. I'm collecting a few things, nothing major, but yeah, I mean, I don't know. It's kind of quiet out there. It depends on what chain, right? So like I think ETH mainnet typically is reserved for like artists, generative art, stuff that's a little bit higher value, people that have they got rich in ETH, so there's that wealth effect.
Yeah.
Base, Solana, that I would say like is a little bit more I guess lower value NFTs, stuff that's like tied to a product launch or tied to a game or community or some type of like token gated content type thing. Just internet memes, things like that. I look at NFT floor price if you want to ever bring up like, the major collections and just see how they're doing. But
so you kind of track, so it's a way to get a sense of the NFT market. You track blue chip prices of things like Bored Apes, CryptoPunks.
Yeah.
Okay.
CryptoPunks, Bored Apes, Pudgy Penguins, Chromie Squiggle. Those are like top 4.
Are they moving higher? Haven't looked recently.
Just kind of sitting in the same spot.
What's a CryptoPunk cost?
$100,000
in current ETH price.
40 ETH.
Okay, so but given it's $100,000, given ETH's 2,500 or whatever,
Right.
so ETH goes to 5, and
Yeah.
maybe that per ETH price comes down because I think a lot of people still look at things in dollar terms.
But this is like
That's expensive. I mean, maybe it's not expensive. Maybe that's cheap. But
I think it's cheap.
Okay.
Considering
you've heard it here first.
Yeah. I mean, I don't want it to be skewed like it's not cheap in fiat terms if you're like a
Right,
normal
but from
person.
a trading perspective, I mean, what's the high in there for CryptoPunks?
Like 80 ETH, 100 ETH.
Okay, some of these have sold for over $1 million, right?
Right, yeah. 80 ETH. 107 ETH was the top in 2021.
Okay. Well, Dan, we got to jump off. Unfortunately, we've run out of time, but I do want to talk a little bit more about NFT trading and more so like the digital art market, because there's some massive opportunities there. I think people have been asleep. Everybody thinks it's about profile pictures, and they're still stuck in the kind of 2021 bubble post FTX collapse. But interesting opportunities abound. So we'll talk about that when you're on the show next.
Wealth effect's huge there.
Yes. Yeah, I want to dig into that a bit more. But that's going to do it for our show. Thank you all for watching and tuning in on YouTube, joining us in the chat. We will be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
All right, Jamal. All right, Nick. All right, Mike. Do you have a long-term trading goal for this year from a dollar or percentage standpoint, or do you have any personal development goals, anything new you'd like to learn?
No, I think that's kind of hard to do. I just try to identify good opportunities for the long term. I have a whole separate account for long-term trades, so I just try to make those trades, whether they're leap calls or whether it's just long stock, and just hold out. I never really put a percentage on it.
That's a great question. Longer term goals would be to get into more futures, building into a core portfolio of futures. I think I've got the options down. I think adding in a little bit more futures trading.
It's a good one. I think everything's always compared to the alternative, which is passive investing or the S&P 500. In really turbulent years like this year, I think if you can beat the S&P, even if you're losing money, if you're down 5% and the S&P is down 10, you're doing better than the alternatives. I think it's a little bit of a different way of thinking of it, but I think if you can beat the S&P this year, if you're making money at a scratch or a small loss and the S&P ends up down on the year, you're doing just fine.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Global markets never sleep. Explore them with Forex. Now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
I made a list of the 7 places in America that I've been to. This is my list. I don't care what anybody else says. There are 7 places that you would drive out of your way, like get off the highway if you're going somewhere to go get a certain food.
Okay. We are ready for your presentation, my lord.
In New York City, you have to go to Katz's. You get to Chicago, you have to go to Riccobenni's. You have to get off the highway in New Haven, go to Worcester Square, go to Pepe's. The original Pepe's. Some people go,
Pepe's Pizza, yes.
You drive straight up 95 until you get to Maine, and you go to Ken's in Scarborough. I was there this weekend. I put it easily among the greatest meals I've ever had. Then my 2 final stops are actually both in Texas. Pecan Lodge in Dallas, and then you go to Austin, and I'm a Terry Black's beef rib person. It's the best I've ever tried. We're going to be in Pilsen. I'm going to buy you a Rico Benny's after the show. I don't want you to buy me a Rico
Well,
Benny's.
that's nice of you.
It's very nice of him, but I don't need him to buy me a Rico Benny's.
I was going there when you were pooping yellow.
Oh my God.
I introduced you to it. The first time you saw it, you were buying it from the truck outside the CBOE.
God.
Sorry, SIBO.
You got to stop.
No, you know that's true. Sadlov, you know that's true.
God. There's not a chance.
My guys, that's the reason why you did what you did in the restaurants that you made, was because I showed it to you. You know that's true.
Do you know that I brought the chicken Parmesan sandwich to Chicago?
What side of the aisle is Tom on? Is Tom stay in school kids, or is he more towards Peter Thiel? I'll pay you $100,000 to go start your own business, scrape your own knees.
I would chop my own off before I would say that I'm on the same side of Peter Thiel of anything in the whole world. I hate that more than anybody.
Absolutely on cloud nine. I was walking around the city yesterday, right? 3 different locations.
What
3
city?
different people all commented about how luscious and beautiful my hair was.
You're walking around St. Petersburg and a random person would ask you about your luscious hair.
They really just wanted to admire it. I was at church, I was at the gym, and I was at Publix. And so at all 3 different locations, had 3 individuals, 2 older gentlemen and 1 young woman said, "Man, you've got some beautiful hair." Now I understand, the older men, they had, their great hair days were behind them, so I understand that. But I'll tell you what, man, I was feeling pretty good. That 22-year-old woman was like, "You've got some beautiful hair," and I was like, "Well, thank you very much."
Did she want to touch it?
No, not necessarily. I turned into the aisle, and she's standing right there, and she saw me. She did like a triple take.
Well, she probably thought you were a Manny since you were doing the grocery shopping, and she was probably looking for a Manny herself.
She
that could do her
probably
grocery
needed
shopping.
somebody to reach the top shelf to get something
And she
to.
picked Jim. There was nobody else in the store.
Exactly.
I'm 5'10", so it makes sense.
Get the full scoop by checking out the archives at tastylive.com.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Tasty Trade has crypto, and you can trade with 0 commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Oh, yeah, it's Wednesday, June 19th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast, give it a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And we're getting our money's worth today. More on that in just a bit. But first, let's introduce our wacky Wednesday guest. We've got the one, the only Chris Revecchio. Chris, how you doing, my friend?
Open the markets. Why are we having a holiday on Thursday? I know it's an important holiday, but come on. Open the markets.
How is this going to work? How's this work again? I forgot how it did. We shut down. Futures shut down after 5. And
Supposedly.
Then what happens?
Like,
or futures are open, but cash is closed. Do you know the logistics?
Yeah, I was looking at the CME Group website today, and Victor, I guess we're going to be watching some things tonight.
Yeah, I don't know if I'm looking at it. Sometimes I get caught, and I'm like, I don't know if I'm looking at a live price or if these things haven't moved in 12 hours. I'm not exactly sure. And I've just been checking my phone for no reason. Shout out to everybody watching. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile application. If you don't already have both, you should go get them. Make your life just a little bit better. But there's only one place if you want to be part of the conversation. Bing, in the middle of your screen. Did we get it? There's only one place to do that. That's on the evil Google YouTube. So head on over to Tasty Live's YouTube channel. Subscribe to the channel, and all of your thoughts will be streamed on screen, both appropriate and otherwise. Chris Vecchio.
So just, Victor, before we start.
Sure.
Futures market, regular open, trading halt at 12, resuming at 5 Central Time. So we have some things to watch tonight. Tomorrow, cash is closed, half day for futures-ish. Not half day, most of the day. But the market's effectively closed.
Yeah, that's always a weird one. When you get the half day and then you open up back at night. So weird. I mean, I don't
kind of like a Sunday. Listen, I think the market we should have 24/7 trading. That's what I think. But
we should. And the only reason we don't is because they haven't figured out how to monetize it on each and every individual trade. SPX down 3 basis points, NASDAQ down nothing. The Dow Jones down 10 basis points, and the Russell, the little engine that could, up 0.5%. Vol got crushed a bit today, I suppose, if I could say it, down $1.50, but still above 20. Fixed futures still at 20.5. Chris Vecchio, what say you, man? Still hanging around 60.33.
I took off Thursday, Friday last week. And when I left work, the S&P was like, 6,000, 6050. And I came back on Monday and it was 6,000, 6050. So I assume it was a pretty quiet few days, which is not atypical because running up into the Fed meeting, things are pretty quiet and it's been a pretty quiet week, right? Everything's priced in. Isn't that what the market's telling us? So
it would have been, I think for most people, it would have been better to just fall asleep and come back a couple of days later.
That's not what I did. No, I unfortunately, I'm one of those meme people, Victor. When you see those, memes of folks who are monitoring the situation, Trung Phane had a good one out today. It was like, this is what someone's eyes will look like who's drinking alcohol and like, different drugs, and it goes all the way down, monitoring the situation, and their eyes are just bloodshot red. But that actually overlaps very neatly with my natural sleep cycle. So the fact that I'm up watching my Mets get their teeth kicked in for a fourth straight game. I went to 2 of those games they lost, and this is their longest losing streak of the season. So is it my fault? Maybe. But I would point out that this is very interesting from a market perspective. We can talk about the philosophical and the human reality of this, which is obviously terrible. But the fact that oil vol is so high and oil has exploded to the upside in such a significant manner, way more than it did in the April or October 2024 episodes of the missile salvos being exchanged between Israel and Iran, yet stocks are reacting the least concerned throughout this entire episode. April was the biggest drawdown. It took us a month to return to where we were before the Israel-Iran tensions. October was like 6 days. We took one trading session, right? We're down Friday. Monday, we basically get back to where we were on Wednesday's close before I went on my little 2-day trip away. Stocks just don't care about this. Maybe it's because, for what it's worth, the earnings profile of our business with Iran for S&P 500 companies is pretty low. Nil, in fact. Also, are we going to really see global oil supplies disrupted? Is that a problem for the U.S. this time around, Victor? 10 years ago, U.S. and Western Europe were right, and that's a huge part of the equation here. Iran threatening to close off the Strait of Hormuz mattered 10 or 15 years ago because Western Europe and the United States were the biggest purchasers of Iranian oil. And these days, Iranian oil basically goes to one place, China. So shut down the Strait of Hormuz, you're hurting China. China doesn't want to see it shut down. So Iran's not going to sabotage the Strait of Hormuz anytime soon. It doesn't impact the people who are waging this war against them. I think this is a very interesting exercise in seeing whether or not the macro matters. Supply chain disruptions are obviously the thing that we're keeping our eye on because an immense amount of natural gas fuel moves its way through the Strait of Hormuz and then ultimately into the Persian Gulf. But right now, it's a good story. In terms of market impact outside of oil, you would not know it's occurring whatsoever.
Some part of me wonders if we just have to get to the other side of expiration here, because like either people got so burned in April, like they're so out of position, they're so jockeying for performance into this end of the month, end of the quarter. Either that's what's happening here, or none of this. I can't imagine none of this matters. Like I looked at the S&P and I'm like, bro, that is, I mean, they are screaming at you what they think is coming. And I think if you believe them, see, the problem with the Federal Reserve is like they've said so much shit that's been so far off that like when they start to put SEPs in front of you that effectively say growth is slowing, we can't maintain inflation's it's out of control, and our Fed funds rate is going to be meaningless to do anything about it for a few years. How do you not flinch at that? And I get that 40 points is a move. We did move 40 points, first up and then down, but there's an accumulation of negative news here, and I just don't understand it, Chris. I don't understand the price action yet.
It's just another brick in the wall of worry, Mr. Jones. And that's what a good bull market needs. Right? Look at the VIX term structure over the past 2 weeks from June 4th to today. The spread between the front month and the back month contracts, 6 points or so. And now we're sitting closer to 3. So it's not like you've seen a big bump in vol, right? It's just that the curve is flattened out. Collectively, the market has been telling us that the past 2 weeks is basically digestion, and we're handling this geopolitical risk fairly well, all things considered, right? You're not seeing gold shoot up to 3,800 and stocks dump 10% and, just an immense amount of volatility in treasuries, but no real direction because, hey, is it growth going down or inflation going up or safe haven demand or, right? This has been exceptionally orderly. There was a part of me last week when I woke up to the news because Thursday morning's my daughter's graduation. And I say, oh my God, I can't believe I'm taking off of work today. But what a good day, right? Like, or 2 weeks ago for Elon Musk and Trump. And then last week, like I'm out Thursday, Friday for just my vacation. It's like, oh my gosh, I'm missing this again. And yet the prudent thing to do on the other side of it was just to ignore it. In both occasions, if you didn't get panicked at a Tesla or you just bought the dip and said it was nonsense, you were fine. If you bought the dip in equities after the news broke, you were fine. I don't know that the lesson here is that nothing matters. And I know a lot of people want to take the nihilistic path and say, well, World War III is coming and stocks are still rallying. One, if you ever see a scare in the market because of World War III, you must buy the dip. It's like a Pascal's wager kind of thing, right? You know Pascal's wager, Victor, the mathematician. Why do you believe in God, right? You do your little pundit square, right? You believe in God and there's heaven. Well, a lifetime of eternity in heaven. If you believe in God and there's no heaven, then you just spend an hour or two a week praying, going to church, whatever. If you don't believe in God and there's a heaven, it's a lifetime in hell. So like the reasoning works out that you should roll the dice and be a religious person. And I don't want to say it's like kind of the same thing here, but kind of seems like it's a Pascal's wager situation. So you were talking about the Fed though, and with respect to the Federal Reserve, they could have just thrown up their hands, given us one of those emojis today.
It's the same thing as last one. It's so embarrassing.
It's more so than last one, right? They tell us in their policy statement that the negative impact of growth isn't necessarily there, and uncertainty around growth has declined since the last meeting. But then when they give you these forecasts, everything is getting hit, and then the expectation bands are widening out.
Yeah.
Powell said twice today, at least, that that no FOMC member is tied to their rate path. These aren't even strong convictions held loosely. These are weak convictions held loosely right now. So all of this can change on a dime. You get a few more, you see further labor market deterioration, a few more inflation reports miss. Powell probably is going to act, but it could really go one way or the other right now.
Yeah, I feel like we're at the wrong price. Some part of me thinks like elevated vol right now, 2021, at this 60-30 makes sense because it's not the right price. But we should be a ways away from here. But I too can't figure out. Do you unclench to the upside and this is a funny money 7,000 market, or do we unclench to the downside and go retest like 5,200 and things are still real and we still got a chance? The world's not. We're not going to live in some Terminator hell. All right. So outside the E-mini
we
S&P,
will, just not this week.
What do you make of the Russell outperforming? Is it like I keep making fun of this trade because you'll get like I say Russell's here for a good time, not a long time. Every time it outperforms, maybe you get at best a 3 to 5 day streak, and then it falls apart. Is there ever going to be a time when you can bet value over growth, or do you just keep buying 1 to 2% dips in the Mag 7s?
Mag 7's a real credit trade. We've referenced this on air the past few days, but Bank of America Fund Manager Survey came out. Top 3 credit trades right now: long gold, long Mag 7, short US dollar. Okay. Incidentally, 4 of the 7 Mag 7 names are not green year to date. So it's a crowded trade, but it feels like it's a legacy crowded trade. A lot of people have just been holding on because the past 2 years, what was the best? Right.
Maybe.
Mag 7.
They just gave you a 35% discount over scaries, though. So even though it feels like we haven't moved that much on a few of these, in the last 2 months, these things have like given you 40%. The biggest names in the market gave you like a 30 to 40% return just to get back to Unch.
Just to get back to Unch, right? So, but I feel like it's people riding it out, because if you look at the fund manager survey, it's been in favor around the same levels as the past several months. So regardless, though, could there be some catch up? 4 of the 7 names are down. Sure, that's certainly possible. Is it crowded, though? Yeah, it is crowded. But you say that this could be a funny money market. Why wouldn't it be? Haven't we seen that movie before, Victor, where you get past OPEX in June, you go through your little window of corporates buying being suspended, and then all of a sudden you enter that sharp seasonality window at the beginning of July, where the first half of the month you just go crazy for some reason. And then ultimately August is choppy, September, October you fall off, and then face ripper into the end of the year. We're kind of setting up for that again, it feels like. And so that's how I plan on trading this market, where right now there's still a week and a half left in the quarter. We have half a day tomorrow, we'll call it, but Friday next week, and then Monday, June 30th. People are still in the hole after missing the market rebound in April when we look at positioning. And so I still think there's an incentive to chase short term. And you can probably get a squeeze. I think you could get a squeeze up here over the next few weeks, absent World War III starting. Although China and, what's the linchpin for World War III arguments around Israel and the U.S. attacking Iran? That Russia is going to come in and provide support, and China has their own interests, so they're going to provide support. There is no indication that China or Russia are coming in to save the Ayatollah's neck at all. Right? Putin has said publicly, we cannot help you. They have their own war going on. They're sending mules to the front line in Ukraine. Do you think that Russia has personnel or armament to spare for Iran? Come on. So if there is regime change, we have to talk about the tailors of that. I'm curious if you had a chance to listen to the Ted Cruz interview yet.
I just saw the clip you sent me, which I was, my mouth fell open. What a brilliant, here's the thing. I just sat down before you, it was so well timed that you sent this to me. Maybe hours before you sent that to me, I was talking about the escalation with my wife, and our son overheard. And I said, okay, I'm going to explain a few things to him. And I explained war. And then I got to this point where I had to explain bomb. And I was like, should I do this? Our son's only 5 years old. I was like, all right, I'm going to try it here. Try it this way. And I explained the word bomb, and he asked a follow-up question, and my wife was like, okay, that's enough. The point is, in this discussion, he asked me, how many people are in Israel? And I said, 9 million. He goes, how many people are in Iran? I said, 92 million. Then he asked, how big are the countries, like the landmass? So I explained to him. So the wildest thing is that when you sent me this clip of Tucker Carlson and Ted Cruz having this conversation, is my 5-year-old son could have told you how many people were in Iran. My 5-year-old son could have told you at that moment, which is ironic. A U.S. senator is completely unable to do so while hawking the same things we were hawking early 2000s.
Are you going to make me defend Ted Cruz here? Okay, so it's April 2013. I'm doing a segment with Fox News and Tucker's producing team about Bitcoin.
But he's
hold on. Okay. This is about the production. Okay, you and I have done enough media over the years where you know that when you do stuff with TV and radio, okay, it could be CNBC, NPR, Bloomberg, even Fox Business, quite frankly, most of the time you go back and forth with the producers to get a set of questions, right? So that way when you go on air, there's no gotcha moments. That's not, if you're doing business television, it's not really like that. It's not a comedy show. So you want to be able to have that guest convey the information correctly. So they inform the viewers, give the viewers a reason to tune back in. When I did that segment with Tucker's team at the time, I recall them asking general outlines. And then when we actually sat down to do the interview, the questions were a lot more incisive. And they weren't like gotcha questions, but they were like, oh, this is really specific. I wish we had talked about this beforehand, because I would have specifically got into this piece of legislation as opposed to saying like what's going on in Capitol Hill, right? And so to me, it feels like Ted Cruz's team, and Ted Cruz was told like, hey, you're going to talk about Iran, why we're getting into the war, just for the audience. And so he obviously doesn't do a lot of prep. He's going to talk about like big philosophical things. And Tucker's like, yeah, what's the specific religious sect of the Shia population in Iran? And it's like, this isn't Jeopardy, man. You know,
No,
so there's
but
a balancing act between the two, but I do agree with the view. Like, if you're going to go after a country, if I'm going to talk about a country's monetary policy, I want to know their GDP, I want to know their labor market situation, workforce employment, inflation outlook, you know, what the demographics look like. And so then at that point, you kind of know about the so you would think a U.S. senator would know, hey, we're trying to topple a regime here. What kind of people live there? How many people live there? Probably should be something you should ask.
Okay. I suppose the way I think about it, and the reason I think my mouth fell open on that clip is because if we, when we go on family vacations, I ain't had much learning, but that's one of the first things that I do is I sit down and I go, where are we going? What's the population? How far away from the equator are we? Like very simple, interesting facts about the place that I'm going. And we all kind of do that as a family. So the lack of intellectual curiosity, if we're invading a country, bro, and I'm a U.S. senator, that's like 101. I don't expect you to need to sit down and do the prep for a Tucker interview where you had to look over the population of the place that we are mulling over going to war with. And I think the follow-up question, which was sort of like the religious makeup of the country, was, okay, you don't know this, and you're pretending like it was a guy. Yeah, what do you know? What about this?
Yeah.
It was sort of a throw-out question. So I look at that and I go, I don't think you should have had to do a bunch of prep for that level of question. I think that should be like top-of-mind information. I mean, the potential of going to war with Iran has been floated for a very long time, and the population hasn't changed. So the fact that you don't know that after how many decades in Washington, that's crazy. It is crazy, Chris. It's crazy town.
It is, yes.
What do you do with it? Is there anything, I guess, outside of the Mag 7? Is there anything that you do like?
Victor, let's just be clear here. Hold on, let's be clear here. If Ted Cruz, Harvard educated attorney from the great state of Texas, if he doesn't have his hands around this issue, I have very low confidence in Donald Trump having a strong grasp on this issue either. And then so like the knock-on effects of we're just going to bomb the hell out of this place and like we're not going to deal with boots on the ground and regime change. I know that's not what they want, but also what happens there. China has a vested interest in making sure those ports stay open. The regime falls. Do we think that we're just going to roll in there, or China might come in and say, you know what, we'll help with the regime change? The wars are not linear. It's like recessions. Recessions are not linear. Right? I cannot possibly predict how this is going to unfold next. So it's best not to go to war.
I agree with that. And I feel like some part of me so drained mentally on this issue in particular because...
Well, have you tried adrenochrome? That helps.
It's been floated for a long time, man. We were just looking for the pretense, We're just looking for the pretense for war with Iran, and it feels like we found it, and it feels like there wasn't an option on the ballot to not get ourselves into a new war. And
that's the funniest thing about this.
Yeah, go ahead.
Who convinced Trump to rip up the Iran nuclear deal? The neocons. Who left the Republican Party to become never-Trumpers? The neocons. Who is giving the neocons exactly what they've been yearning for since the late 1980s? I mean, didn't we arm Iraq to fight against Iran after the Shah fell?
Mm-hmm.
So this has been something in our minds since 1979, perhaps. And the neocons have been pining for this for my entire life, your entire life. And Trump's going to be the person to give it to them, even though they've worked the hardest to make sure the Republican Party wasn't united behind him. It's really fascinating.
No, sickening. It's sickening, bro. Do you think we're in this? I asked Ilya the same question. Like the whole peace through strength promise of the current administration, it becomes really hard without credible deterrence. And I think you sort of made this tongue-in-cheek joke one time when President Trump responded to Putin with that tweet. Stop, Vladimir. It's like, bro, that is not credible deterrence.
Yeah.
So some part of me wonders.
This is credible deterrence. We've moved 24 Stratotankers, which are our major refueling planes.
That's my point.
Into the region. Right. Yeah.
This is the thing that you have to use as your credible deterrence.
This is the red line that I wanted. This is when President Obama said, this is a red line for me. This is what you do to back up the red line. You move a carrier strike group into the region. You move a third carrier strike group into the region. Wasn't it crazy a few weeks ago when I said, how come we're moving all these B-52s, these B-2s out to Diego Garcia in the middle of the Indian Ocean? Remember that? It's a staging ground for when you attack things in the Middle East. And sure enough, the dots were there, right? It was kind of like those blood tents that Russia was setting up on the Ukraine front line for their drills in December 2021 and January 2022. If they're drills, why are you setting up hospital tents with all this blood being transported to the front line? What? So the breadcrumbs are out there for people to follow. If this is a peace through strength, escalate to de-escalate, this is the most credible way that you could do it. Because otherwise saying like, hey, if you do this, we're going to come get you. Okay. You keep saying that to me. Okay, but now we've moved all these assets into the region. So maybe it's just a bluff, but the threat looks a lot more credible than it's ever looked, as far as I'm concerned. So maybe that is what happens here. There have been available public reporting, Wall Street Journal, what have you. The Trump administration sent a proposal to the Iranian regime yesterday. The Iranian regime rejected the proposal, but according to the sources in the White House, the rejection was done for, quote, a good reason. Okay, so if that's the view from Washington, forget the bluster of Trump's tweets of unconditional surrender and, kill him, parenthesis, or whatever. If there are any off-ramps here, right, that's the most positive view for the market, because an off-ramp would mean the nuclear threat is deterred. I mean, I would imagine part of the deal would be like, we're going to bomb the hell out of Fordow and Isfahan and all these other sites in Iran that have been part of the uranium enrichment process, the ballistic missile process. The military is going to be gutted. The energy infrastructure will remain in place. Okay, like that's in everyone's vested interest. So there's still a path here. The images are ugly, but there's a reason why the market's so copacetic about this, and we need to respect the fact that the price action in the riskiest things is telling us right now we should stay cool and calm about this.
Why wouldn't you anyway? Like, what would be the reason?
If I get really bared up, I get vaporized. If I'm right and World War III starts, I get vaporized. Who's my counterparty? How would I collect on this?
Not even that. just generally speaking, war is something you got to pay for. And anything that increases the deficit nominally is probably bullish for asset prices. Maybe not on a real basis, but nominally. Unless treasuries get to some level that we're all going to get vaporized anyway through high debt costs. Like, I wouldn't understand why you would panic.
Vaporized by high debt costs, or as another inimitable senator might say, everyone dies.
Mm-hmm. What do you think about bonds here? 113.21. They're just magnet. They're getting sucked back into 114 land with almost no vol. I almost want to stop asking this question because it's the least interesting asset, even though for a long time it's been driving all the price action. It's like I want to get a Snickers, say not going anywhere for a while. We're going to be at 114 plus or minus 3 points. So who the hell cares about bonds anymore?
Yeah, who cares? I think that's a good point. The trade was more interesting a few weeks ago when you had higher volatility and there were some of those candlesticks flashing signs of bottoming. And I think those candlesticks ultimately in hindsight were valid. Bonds have kind of churned higher here, although they gave up some of their upside today. Nonetheless, I think the notes are probably just the more typical tasty trader kind of way to approach the market. It's not, the vol isn't thrilling, but you do have a very clear range over the past 6 months that's been well respected. So being directionally neutral in there, it's not the trade you post to Wall Street bets about or write home about, but it's the kind of thing that's a step. It's not going to be the thing like, oh my God, look how much money I made, or oh God, I blew up my account, like I can't, no more chicken tendies for me, right? But it's one of those little things you put in the work. No one likes blowing their nose, Victor, but you got to blow your nose. Okay. There's some maintenance things you got to do. It feels like a maintenance trade, just kind of to do something, but it's enough. And so we're at close enough to the midpoint of the 6-month trading range. Stay directionally neutral if you can. That's what I'm doing. ZB, I have short put spreads on, also some long out of the money calls if the technical interpretation of a bullish falling wedge is correct. Otherwise, you're right. It's not interesting right now because the Fed's not interesting right now.
2 years ago or a year and a half ago, I take you back to the sentiment in the market back then. And I tell you, Israel and Iran are firing missiles back and forth, and our president is talking as if we're going to get involved. And
bullish LMT.
How would you have thought about the demand for treasuries in that world versus what is happening in real life?
That's a really good question. So if we lean on history here as a guide, when the market has judged wars to be something that are going to be, there's like a really interesting pendulum here. So work with me on this. And it's not just kind of one or the other. It's almost like an XYZ axis.
Okay.
If wars look, yeah. So what makes me think of this? There's a lot of thoughts I have to unpack here. Go back to the Civil War, for example. When the Union won battles, treasury yields would fall, gold would fall, because it was assumed then that the U.S. government would have to issue less debt to finance war efforts moving forward, right? It's going to be a shorter war. We're winning the battles. When the U.S. lost battles, when the Union lost battles in the Civil War, gold prices rallied, treasury yields went up. The Union's going to have to print more money to finance a longer war effort. Okay. So there's that in our pocket. There's also the fact that when wars are deemed to be really, really short, you're not going to see any disruption of growth. So when we bomb Iraq in March 2003, for example, the initial reaction is higher stocks, higher treasury yields. And if you look at how the markets reacted this time around, you're kind of seeing a similar situation where we're not projecting a long-term demand for safe haven assets here. Gold prices have certainly stepped back. Treasury yields, they've bandied around back and forth, but they haven't made any significant progress as if there was a haven bid in this market. So you could almost glean, Civil War is a long time ago, okay? But if we think about this in the more contemporary sense, an equity market that's up and yields that are moving sideways to slightly higher suggests that we're not expecting any significant negative growth effect, knock-on effect from this. No impact to corporate earnings, no impact to consumer spending. And that then necessitates the view that what we're seeing in oil would thus be temporary, because if you have a 10 or 15 or 20% rise in oil, forget over the span of a week, which we just saw, or 2 weeks, but really over the span of like a month or two, that's going to negatively impact consumer spending. So right now, the market's bets are that this is going to be contained, and because it's contained, there's no reason to reach for safety.
I agree with that. I don't know if it's then, though. I agree that in the short run, that ZT, like the short end of the curve, is not really budging to the extent that they believe that crude oil will be meaningfully higher, will stay meaningfully higher, and will create a cause for a change in inflation expectations. I do agree with that part. And then independently, I do agree that there is not really a demand for long end treasuries. But I don't know if it's, I think there's room for those to be independent. I'm not saying that that's inaccurate. I'm just saying there's room for those two things to be independent. I do think the market can see this as short term, but still be unwilling to buy U.S. debt. Or I could see they think it as long term and still be unwilling to buy U.S. debt. I think those things are both possible.
If Iran falls, what are the implications for BRICS and a competing system for a Western-led world? Russia and Iran have a defense pact signed together. Russia has said they can't support Iran.
I don't know that it's binary like that, though, because, if Ukraine falls,
sure,
what does that mean about the U.S.'s ability to protect those that are under its?
Yeah.
So it's like, just because we're going to get to this place where we're not going to call it a loss, we're going to save face in some way, shape, or form. But all the propaganda that we spewed to get ourselves into this was inaccurate, and we're going to back our way out. And so the same way you're talking about Iran, the world could be talking about us with Ukraine.
No, I think we have been, though. I kind of think of this as like a pendulum, right?
Mm-hmm.
And I would think that since COVID, the pendulum has been swinging away from a U.S.-led world. And part of that is the Russian war in Ukraine. Part of it's our political dysfunction here. But and it looks like, China is elbowing everyone out now, right? Like, are they going to make a move on Taiwan? They have their own aircraft carrier. They're at the front of the curve for AI tech as well. They managed to pop their property bubble without killing their economy. And hate to say it, but people under the age of 40 in China have a higher percentage of homeownership than Americans under the age of 40.
What's the percentage there?
68% now.
For under 40?
People under the age of 40 in China, 68% own homes.
Our entire home ownership is like 63%. That's crazy.
Yeah. And under the age of 40 here in America, it's somewhere closer to like 32%.
No way.
I swear
68% for everybody under 40?
I will source the figure. I don't have them in front of me right now. It's going to take me time to find. I was reading this literally last night. That's why this figure is on the top of my mind. And that kind of blew my mind. Right?
That's insane.
So there's a world here where the pendulum's been swinging against America, cost of living, the K-shaped recovery post-COVID, right? The vibes are all off. Maybe this is a turning point. Okay, hold on. These countries did set out against America. They've been set out against America for decades, and it ended up like every other totalitarian regime that has gone against America. If it was a Gaddafi or a Saddam Hussein, or now it's an Ayatollah. We again, there are lots of negative externalities there. Gaddafi and Saddam Hussein were pretty bad dudes, but what sprung up in their wake? You don't have ISIS without Saddam falling. Saddam was a counterweight as a Sunni Muslim to the Shia regime in Iran, right? So again, wars unfold in non-linear paths, suggesting that we're just going to wipe out Fordo and the Iranian regime collapses, and we could all go home, and we reach Francis Fukuyama's end of history. That's just not how the story is written.
It's almost always not as quick as the markets nor the people and pundits pontificate for a little alliteration.
How long did the Iraq and Afghanistan wars weigh on markets, Victor?
Fair. I'm just saying, like, the way people thought about Ukraine was not as if we would be 2.5 years later still talking about how to negotiate to a peace deal. The way people framed that up for the public and thought about it, communicated it was going to be sort of a quick resolution, and it was anything but.
Kyiv would be down in 3 days, right? That was the Russian,
exactly.
And it's now Putin came out tonight and said that he's ready. He's finally ready to negotiate a exact words, substantive talks with Ukraine on principles of peaceful settlement, and that's purely because Israel just wiped out Iran's S-300 surface-to-air missile launchers, which is basically the defense architecture that Russia has, because these are all old USSR equipment, right? And if the Israeli military can take out Iran's defenses like that, and now Iran, who's been supplying Russia all these Shahed drones to terrorize Ukraine with these unarmed aerial vehicles just dive bombing into buildings, blowing up, they're losing one of the very significant piece of their arsenal if the Iranian regime falls. So Iran falls, there are implications for Eastern Europe. There are implications for the EU. Do you think the EU feels more confident that it can stand up to Russia in the East moving forward? Hell yeah. They're definitely going to plow forward with all that defense spending, right? If they could stand up to Russia without that spending, imagine the force they'll be thereafter. So this is the most important event that's occurring right now. And by the way, Victor, can we say what a horrible calculation again October 7th was? Think about the dominoes from that event. Hezbollah falling, the Assad regime in Syria falling, Gaza is flattened, Iran may fall now, all because of October 7th.
Mm-hmm.
Things don't move linearly. I don't think the Ayatollah was thinking on October 7th that he would be watching his capital city be bombed 2 years later, right? So,
yeah.
Can we get out of these interesting times of history? This timeline sucks. I think I've said that 3 episodes in a row. This timeline sucks.
Yeah, let's get out of bonds too. Let's talk about something fun. What do you think about Bitcoin at 105? There's a lot of news flow here. The stablecoin bill, institutions snapping these things up like Tic Tacs, everybody copying Michael Saylor. Why buy any other asset? Why not just buy the Apex asset, Chris Vecchio?
I don't know. You don't see me. Not that I would say one way or the other, but I'm not hodling Ethereum or strategy these days.
Yeah, but I'm saying why hold Nvidia? Why even hold Amazon? just hold the Apex asset with all your money.
The stablecoins are really. Oh gosh, you got to own real estate now. You saw those building permits and housing starts figures today, right? Who's buying any properties at these levels? Mortgage rates are still 7%. Home builders are watching their supply chains get into disarray because of all the tariffs. We could talk about the labor argument here, and I know and I see it here frequently in the chat, so I do want to take a quick moment to clarify my view on this. Don't
worry about those psychopaths.
I do. I think intellectual honesty is a very important characteristic in this modern world.
But you need to know, this chat is a special one. They'll give everybody shit. Everyone, they throw elbows at everybody.
I'm aware.
So you get in here, you just gotta.
Oh, it's not just this chat.
That's it.
Right. One of the claims I've seen is that people are saying you can't get rid of all this labor supply, all these undocumented immigrants, because it's going to upend so many key industries. And then the retort is, okay, well, you're bringing in all these people that are basically glorified slave labor, right? Okay. I agree that's a problem. I'm not saying we should be paying people livable wages. I think it's a total joke that the federal minimum wage is $7.25, and here in New York it's $15 an hour. And if you look at how productivity has moved with the economy since the late 1970s versus wages, the minimum wage today should be north of 30 if it tracked productivity the way that, say, CEO pay has risen. I'm all there. I'm there, okay? But the reality is that if you remove a people who make X dollars in your labor pool, and you have to replace them with people who make Y dollars, it's going to cost more. It's going to push up prices. It's not rooting for a permanent class of subservient people in the country. It's just the understanding that if you remove the people who are willing to work at these wages, the work is not going to get done, or you're going to see massive cost spikes along the supply chain.
It doesn't have to work like that. It can also
maybe not.
It could squeeze profit margins. But we pretend like that's not possible.
When has a business ever said, I agree. In the grocery industry? It's one of the reasons why, for all the things going on with Zoran here in the New York City mayoral race, the talk of the groceries, the publicly funded groceries, kind of throw me for a little. Have you ever looked at the math behind it? Groceries chains margins are 2%. Yeah, it's nothing. They are the ones who make it up on the volume. So if you're going to get involved in something, you go for a high margin business, something with a 20% margin. But at 2%, where's the possible improvement there? So when I say how come they could always just sacrifice profits? Yeah, they could, but are they going to do that? Right? Just like the answer is we could always raise taxes, but is Congress going to raise taxes on the wealthy? No. So it's just the real politics of the world, not what we want to occur idealistically, but what are the constraints we're currently operating within, and how do we get around them, work within them, overcome them?
I agree. You brought it up. What do you think about the mayoral race in NYC? I've been following it sort of loosely, as much as you can from the outside.
I'm going to take a lap here. Last September, when Eric Adams was indicted, I said everyone should keep an eye on Andrew Cuomo.
Yeah, you did call it.
Right. Not because I'm a Cuomo fan, but just understanding the politics of the area. I'm entertained right now. The Democratic primary basically means nothing. So if you're following the New York City mayoral race, understand that we have ranked choice voting here in New York City. You can put up to 5 people on a ballot. And so you go round by round, and the lowest vote getter each round gets knocked out, and then their votes are redistributed to the remaining candidates. Because of all the party lines here in New York, Andrew Cuomo has an independent party line that is already secured. Zoran Mamdi, I keep tripping over those words, his last name, I apologize for that. He has secured the Working Families Party line. Eric Adams is running it.
You and Cuomo in that debate.
It's the Italians. It's the Italians.
Didn't he correct him? Didn't Zoran correct him?
Yeah.
I hate when people do that stupid thing. I hate it when Kamala did it, and I hate it. Like, some people.
No, I get it.
It's like,
your last name is Jones.
Your name's
Your name is Jones. No one gets that wrong. I've heard Vecchio.
So you have like an
Vecchio,
affinity. You have an affinity to when people get your name wrong, getting pissed off.
Vecchio. Okay. There's a bridge named after
Aaron. Aaron.
Exactly. Great reference. So, okay, so you have Eric Adams running on an independent line. You have Cuomo, who's already secured his own independent line. Zoran's already secured the Working Families Party line. And then Republican Carlos Silva, Angels guy who always wears the red beret. He's like New York's Tom Sosnoff. He's going to run as a Republican. So no matter who wins the Democratic primary, you may have a 4-person mayoral race no matter what. And that is the most entertaining outcome. Because
the most entertaining outcome is Eric Adams wins.
Because that's the world where you get Eric Adams winning, or you get a Republican mayor of New York City. And like,
how crazy would that be?
If Cuomo doesn't win the Democratic primary, I think he's going to back off. I think Zoran's going to run no matter what.
What do you think about Zoran?
He's interesting.
He makes me very uncomfortable. My spidey senses go up. He's too polished. He's too good.
He has his mother's a famous film director, and so someone said this to me recently, like, oh, you're very sharp with your tongue. It's like, well, I grew up in a household with 2 attorneys. I had to be. That's how you fight for a word in edgewise at the dinner table. Okay,
yeah,
otherwise you're getting cross-examined.
You can be sharp, but you can be polished, or you can be practiced and rehearsed. And when I listen to him,
you don't think I'm polished and rehearsed? Every time before Teapot, I stand in the mirror and I go, adrenochrome. I'm
telling you, every time it works. No, that won't get me to laugh. That'll get me to cry. Ivermectin will get me to cry. But he's very like, I just feel at that age, you usually don't have like that level of just political polish. You're a little bit messy, you're a little bit angry, you're a little bit emotional. You don't have the ability, any question he knows that will be controversial. He has this way of dancing around it. I'm not being sympathetic. I know some of his ideas, some people on this network might not like, or vice versa. I'm watching from the outside in. All I'm speaking to is his authenticity. Something feels off. It's like the Men in Black, the alien in a human's body thing. I I get that impression with Zoran. Even though I think Cuomo's the worst.
One thing that he's done very well is he understands the media environment, which is that we're post-literate, and so you need to have people's attention. And I think a lot of Democrats are allergic to media because they, again, the voting coalition for Harris versus Trump, right? College-educated folk, they're going Harris's way. Trump has the largest multicultural working class coalition since Obama's 2008 win. All right.
There's no way he holds that together, by the way.
No.
It's falling apart already.
Of course, right. So I would then turn around and suggest Cuomo has a certain group of people that like him. Zoran understands that he can get to more people by being in media. Cuomo is older. He is from the older generation of Democrats that think that you need to be studied, that you communicate in long form, you write things out. This is the old party of the lawyers. Okay. And so these candidates just aren't cut for the information environment that we're in right now.
Mm-hmm.
And that was Biden's problem too. Once Biden got in front of camera, you're like, holy crap, this guy is much older than I remember. And I think that's a lot of people's perception of Cuomo. Personal issues and scandal aside, which are all horrible, okay? And I know a few of the people that have accused him of the things that he's been purportedly accused of, and I think those women are believable people. They have no doubt in my mind that what he was accused of is true, from what I understand of the situation. But his age came through on the stage the other night, and his poll ratings have gone down. You're right about Zoran being a little bit too clever and polished with some things. I found the globalize the intifada comments yesterday that he gave on the Bulwark podcast a little concerning from my own view. Okay, well, he said like he tried to equate it with intifada is the Arabic word that was used when you read about the Holocaust and the Warsaw Ghetto Uprising. But the context in normal times is that the intifada is the struggle against Israel from river to sea, and where it happened to the 9 million people that live in Israel, if you're driving them out of the land, okay? And Israel is a place. And the intifada, if you read Hamas's founding charter, it specifically calls for the extermination of Jewish people. And I think this is an important distinction to make here, because Israel is a place. Jewish people are spread around the world. Okay, so when you say globalize the intifada, you're saying globalize this resistance against not Israel. Israel isn't everywhere around the world, but Jewish people are. So I find these flirtations on both sides of the aisle with some of human beings' worst impulses to be terrible. But I think that's a function of the world that we live in, insofar as people, as FDR said in his April 14th, 1938 fireside chat, people are willing to give up liberty and freedom if it means putting food in their kids' stomachs, feeding their family, was his exact words. And people are willing to embrace the crazy of it all if it means they can break out of a system that's keeping them down. And that's why we need economic opportunity for people. We need ladders, not chutes. When there's economic opportunity, crime falls, right? People flourish. Human ingenuity soars. People are falling behind these days, and we don't have any solutions in place that make it better. And I don't know what going to a war with Iran does for building more housing in this country. So I consider me against it.
Yeah, it doesn't. I'm still blown away by 68% under 40 homeownership. It's blowing my mind. I haven't stopped thinking about that number since you said it. Is any part of you, I know I'm going to get you out of here, but you mentioned the home builder numbers earlier today.
Mm-hmm.
I don't know what's wrong with me, bro, but like I can't stop thinking about the home builders. And they're off. Most of them are down between 35 and 65%. I got your
stat here, by the way. According to HSBC, 70% of Chinese millennials own their homes. 35% of U.S. millennials own their homes.
That's so wild. That's so freaking wild.
46% in Mexico, 41% in France, 31% in the UK, 26% in the UAE. I have no idea why these were the 6 countries chosen for this particular graphic, but this, like, why is the UAE on here with the US and Mexico? Okay. But yeah, if you want to share this on screen, this was a screenshot from the BBC and HSBC.
I'm not at the home, so I'm not doing a screen
gotcha.
share. I'm just doing the platform share. Otherwise, I would.
Okay, well, now
I'm
you have the
over
graphic in the chat too.
I'm in Thailand right now. Do you know that?
What's the population of Thailand, Victor? Come on. Well, at least give me the ethnic groups.
Hold on.
And you want a vacation in this country?
Hold on, I looked it up. Now I don't know what to say. I think it's way more than you think. I think it's 190 million.
Yeah, it's huge.
I think it's 190 million. Somebody check me on that. Some reason I wanted to say 70 at the beginning, but I knew that wasn't right. Somebody check me on that. 190. Home builders. Have you been thinking about them at all?
I have been, and not in a great way. If we're going into a world where we have these supply constraints for whatever reason, we don't need to go into those specifics again, but let's just say there are supply constraints. If it's through human capital or physical capital, we don't have the people who are willing to work at current prevailing wages. We don't have the ability to source supplies at a reasonable cost. Building new homes is going to be difficult. And that puts existing homeowners and existing facilities in a better position than new facilities, right? And I would point out that over the last few weeks, real estate investment trust ETFs have been holding up a little bit better than the home builder counterparts. And that probably is the way of the world for the foreseeable future, which if we're heading into an environment that the Federal Reserve is appropriately painting lower growth, higher unemployment, higher inflation, stagflation, you hide out in a few places, but things that tend to be inflation sensitive or not so sensitive, like gold, but also like housing. So I think that if you're going to be a housing bull, you have to be a very specific type of housing bull now. I'm apoplectic over seeing the state of housing right now. You and I have gone back and forth about this for years, and we're just digging ourselves into a deeper and deeper hole with each passing year.
I agree with this, but this is when this is my problem, man. This is when I get excited. The only time I get excited about things are when nobody wants a thing. Like when everybody's got the negative reason why something is a bad asset, why it won't work. And I do agree that I almost can't see in the next 6, 9, 12, 18 months, I can't see a reason why these would be doing really, really well unless there was some need for the Federal Reserve to implement some Operation Twist or some yield curve control. And you drop rates.
Don't threaten me with a good time, Victor Jones.
And then you get this window of time where people can buy, where they can afford, and they probably buy them up. That would make home builders go absolutely insane.
Well, the market is hugely oversupplied right now. Redfin, we shared the chart on overtime earlier, but Redfin shows
35% more supply, something like that.
Yeah, home buyer. There's a 500,000 gap right now between those that are on the market and people looking to buy presently. And that's blowing out to levels that we haven't seen since the global financial crisis, right? Year over year, home listings are up, I think now 17% year over year, which again, you haven't seen that type of home listing growth since the global financial crisis. But then again, most homeowners, the prevailing mortgage rate in this country is like what, 3.93 right now? So even if things come back in, people who own their homes are fairly well insulated still. It's not 2007, 2008. And then how do you get into this market? If you're in the market to buy a home right now, you're basically hoping for a crash. You're hoping for some economic calamity so that rates come down.
Yeah,
that is not the incentive you should be rooting for.
So here's what I think about. So I agree. The housing market's toast, bro. And the only thing that hasn't happened, no, it's toast. The only thing that hasn't happened is people have started to report on it because it's not cracked enough for it to make it newsworthy. But it eventually, the state of the housing market is going to start to show up on the news. We're just not there yet, but it's toast. But my question is the damage to the assets already done? And so some of these things are down 40 to 60%. And I know something that goes down 60% can go down another 80. I totally get that. But I just can't help thinking that there's some there's some value to be had here. I don't know if it's at this price, but some sick masochist portion of me just wants to jump in there and start being the guy who's long home builders. And I bought a few of these the other day, not a bunch, just like less than 10 grand worth. And I'm starting, man. Are you coming with me, Vecchio?
Not home builders. I'll see you in the REIT side of things.
That's fair enough. If the people want more from you, tell them where they can go.
At CVecchioFX, here with Victor on 2 Wednesdays. Although next week, I think we got to flip next week. So next week, Tuesday, 6 p.m. Eastern, 5 Central. Also, let me explain on Tuesday mornings with Tom and Tony, 9:40 a.m. Eastern. And then overtime with Radigan and Spivak, Monday through Thursday, 4 Eastern. Futures Power Hour, Monday through Friday, 1 p.m. Eastern.
Right on, man. I was right the first time. Wrong. So it's not 190 million. It was 70 million.
Indonesia?
Yep.
Or Thailand?
Yep.
Thailand. Okay, yeah.
All right, my friend. I will see you. For the rest of you knuckleheads, I will see you tomorrow, bright and early, same time, same place, same great network, only on Tasty Live. Till next time, peace.